Dylan Radigan is entertaining Tom in Milan, as best I can surmise, and Chris is in a heat wave trying to figure out why his house is 110 degrees on the inside. So these fine gentlemen are joining me. I'm Ilias Pivac from San Francisco. That's Mr. Mike Butler and Thomas Westwater from Chicago. Gentlemen, how goes it?
We're nice and cool in here. So, I was trying to walk Chris through his AC problem, but, can't handle the heat. So,
yeah, 110 is that is rough. That is rough.
Yeah. Inside one's house at 110, I'm not sure I'd have anything cogent to say about market action either.
No. And I just checked to see if there's a Mets game right now, but there's not. It's in 2 hours. So he's not there. He's not lying. He is fixing his AC.
Fingers crossed he can actually make it inside his house and see any of it at temperature below melting.
That's insane. Yeah. Stay safe out there, anyone on the East Coast. We had a little taste of it yesterday in Chicago, but the last couple of days in Chicago, but it has cooled off dramatically.
It's been foggy and cool here in San Francisco, which I'm not complaining about in the slightest. Let's take a look at, by the way, view the transition here. A place where things are not cool. Micron. Mike, you were just talking about this in the green room before we got started. What in the world? What's going on here?
It's the classic meme of the thing like poking the stock saying do something, and then the green bar just shoots through his head. That's what's happening. Yeah, I mean, I did an earnings preview on Micron, and it looked like everything was good. I mean, they are investing in U.S. expansion, which I think is good for potential tariff stuff. I mean, they've just had an insane rally. Their stock had doubled from the low of April. And it just goes along with the story for the rest of the chippies. I mean, AMD, NVIDIA, very similar charts, but I was wondering if it was going to be able to continue. I mean, even when you have a stock perform like this, they still have to just crush their numbers for it to continue. So I don't have it in front of me, but I assume that they demolished numbers and they have some good news for the rest of the year.
It's interesting because if you look at the sector breakdown here, it's not what you might expect with this kind of a move. I mean, sure, tech is up a good 0.8% here, but generally not the world's most risk-on mix. Consumer discretionary and staples both down quite a lot. Discretionary down 1.25%, staples down 1.3%. Not really what you'd love to see. And if we look at sort of where we are on the overall S&P here, kind of a goose egg. And NASDAQ, not much better. I mean, there's that up, about 0.2% here as we get into the close. So it's pretty localized after we get this, oh no, war. Nope, not war. Okay, ceasefire across these two bars right here. And I mean, it's pretty evident across the various markets. What do you guys make of the pause here? I mean, if all is well and good, are we just pausing to digest, and since we've taken out the previous high, it's off to the races, or does this give you any cause for concern here that we're not finding momentum on a third day?
I mean, volume was pretty light today, so I think the market is just digesting a little bit. Yesterday was really encouraging. We broke through those June swing high levels. So, it makes sense that the geopolitical fear subsided. We broke some levels there. Now we kind of consolidate to today. Economic calendar is pretty light tomorrow, but I think MU earnings, it could help the tech sector tomorrow break through. I think tomorrow's going to be an up day. I don't think light volume here is really an ominous sign after, you get a nice 2-day rally and you break some technical levels. So I think you get a little digestion, people taking off their longs, they'll reposition. I'm going to be positioning myself on the long side tomorrow morning. Kind of sitting on my hands today for equities. I was going to get long SMH to kind of play the MU earnings, but just did not happen. So I think we continue to drift higher.
Yeah, I would agree. I think just looking at volatility alone, we are back in the mid-teens in the VIX. VIX at 1677 closing print. So we are back at the lows of early June, and that was kind of the lowest we've seen since April. So swift reversal of implied volatility, and we'll see if we can break through to new all-time highs in E-minis. It's craziness.
Yeah, I mean we're basically we're looking all the way back here. I mean, this is kind of the floor on VIX, essentially going back to late March. So this is quite something. I took that technical break yesterday that Thomas is discussing to get myself out of short exposure on the indexes, and so this break above this high on ES, that was enough for me. Goodbye. And then on NASDAQ, of course, same thing here. That was the high. The logic was that the risk reward here, since you couldn't really get out of this range despite whatever news was going on with the US and China détente back, with the war, but then obviously yesterday the market seemed to make up its mind. And so thank you and good night. So at this point, I am on the sidelines and waiting. I think we're kind of in this strange area here. If we just take a look, let's say, at the continuous NASDAQ contract for the sake of argument. Now, and of course, this is not a tradable thing, so take this with a grain of salt. But we're basically back to this kind of digestion zone where we were sort of at the end of last year going into this year. So when the tariff implementation stuff spooked everybody mid-February, gave us this sell-off, before that, we were sort of wondering what is going to happen after we digested the election and went into the holidays. We're back to that kind of deciding line. And if you look at the same thing in ES, same spot. Now, it's not quite as dramatic looking if you look at the current contracts, but you're still in this kind of digestion zone where the highs live and where the market was attempting to kind of make up its mind about what this year is going to be all about. So I don't think the risk reward to chase this higher with new long exposure is particularly great. But I'm not prepared to continue to fade this kind of momentum. It's going to have to convince me that it's ready to do something different for me to jump in front of it again. Thank God for verticals and risk defined positions and ETFs like SPY and Qs that let you have smaller size. That's always good. What do you guys think? Is this something that you're sort of leaning into directionally at this point? I mean, vol is pretty low, so there's really no premium to sell here, it seems. Are you laying on new exposure? Seems like you're both pretty bullish, especially going into tomorrow. Is this a reason for people to be looking at overnight futures contracts and going, I need to get long ES, I need to get long NQ before the day kicks off tomorrow? Are we chasing this thing?
That's a scary thought. But yeah, I mean, I think volatility is really low. We're kind of in this chop period. Not a lot's going on. I've been taking off trades for winners less than 50%. I've been closing scratches. I'm just trying to like free up a lot of capital as much as I can while still managing other positions and waiting for current positions I have on to let me know what I need to do. But yeah, I think right now I'm more positioned towards having cash on the side just in case something crazy happens. But at the same time, I do lean a little bit bullish with the strategies that I'm doing. But I'm doing them small to find risk. So like the Micron calendar spread I had was a $387 or $370 debit. So very small trade for earnings. It should work out well if we stick around this 130 to 135 range tomorrow, because I've got the 135 2-day short option against the long August call at 135. So looking good there. But yeah, just trying to keep risk small and find new opportunities where they present themselves. But yeah, when the overall market volatility is low, it can be a lot harder to find those opportunities unless you're going to high implied volatility equities.
Yeah, I might do something like buying and calling SMH tomorrow. I think with volatility low, definitely keep capital on the sides in case, we get some event that causes that. I don't know what that is right now, We have durable goods tomorrow. That could move the needle a little bit. It seems like we're wanting to see that September rate cut odds increase right now. So I think, that's far away enough that if September increases, it's not signaling something like there's a dire economic, something is happening bad in the economy. It's just that, the Fed is going to shift more gradually dovish. I think that's good for markets. Whereas, if a rate cut expectations increased for a sooner meeting, that would signal something bad is happening. So I think, if the Fed starts to shift, and market rate bets have been going like this a little more dovish, I think we're going to see more upside. We got, also the PCE later this week. We got the GDP tomorrow, although that's the third or final reading. So, that number would have to change pretty substantially from the second reading to really shift the focus there. But these Micron numbers are good. We've made this gap to new recent highs. Volatility is low. I think that all points to us kind of drifting higher. At the worst, I would say, is we establish a new range to carve out. But in any case, with the exception of something unforeseen right now, I think a sell-off doesn't make sense here.
Yeah, you'd need some kind of
interesting.
Catalyst, feels like.
Yeah, absolutely. I mean, as I say, I'm certainly not prepared to fade this. But Thomas, you mentioned Fed policy odds. It's an interesting thing that's happening in markets, and it's probably the thing I'm paying attention to the most. This is the SR3, so the 3-month SOFR contract for the end of this year. And this is just a sort of a benchmark for where Fed policy odds are going. And you can see this starting to look a little bit more dovish here over the past several days, which is interesting in the context of what the Fed has been saying. Powell testified for a second day here in Congress today, and it's a very familiar song and dance. We heard it in the wake of the FOMC meeting last week, and it's, we don't know what the tariffs are going to do. We're going to wait and we're going to see. We don't have a high unemployment rate. We don't have a high inflation rate. There's really no reason to do anything until the economy sets off some sort of alarm bells this way or that. And interestingly, the Fed actually dropped a rate cut from their outlook in the summary of economic projections last week. So they think they're only doing one cut next year. The markets are pointedly going in the opposite direction, as if to tell them, no, you're wrong. Actually, it's something else entirely. And you're starting to see it here in the contract for this year. So as ever, this is the price. So the way you get at the yield is 100 minus this 96.27. So this going up is yields going down. And you can see this dovish shift for this year, but the really dramatic effect is actually next year, where you see a lot more rate cuts. Even as Powell says, actually, this should be going lower, the market is saying this is actually going to go higher. And so the Fed is at 75 basis points through the end of next year, 2 cuts this year, 1 cut next. Market's at 120. So the market is essentially saying not only will you do more than 1 next year, you're definitely doing 2, and about 50-50 shot you're doing 3. What in the world are you talking about? And so this is a very interesting disparity here, because either the market sees some sort of an economic downswing ahead, and it's sort of looking through what the Fed is saying could be a one-off impact from the tariffs, or it's just basically doing the math that the Fed is doing differently, and essentially saying the impact of these tariffs will happen on a different timeline than the Fed is saying. It's going to happen sooner, kind of wash out sooner. So interesting to see the market very much at odds. And even for July, the odds of a rate cut have been rising. Now, they're still very low. So a week ago, we were looking at a 12% chance of a cut. Yesterday, it was 18. Today, it's 25. Now, obviously, that's still 75% probability in favor of no cut at next month's meeting. But 25 is getting a little spicy, especially when the Fed is telling you we are not doing anything. So what is it in your mind that the market is seeing here? Because it'd be one thing if the markets were saying, okay, you know what, you're slowing now. There's an exchange rate between rate cuts now and rate cuts later because you will have allowed the economy to run in the wrong direction longer. So you're going to have to do more later versus now to catch up. So, okay, we saw this, by the way, in very sort of stark relief last year, and you can see it on the chart here. So when the Fed was lagging last year, the market said, oh, well, so build more easing further out into the forecast. And you see these rates come in. Then, of course, the Fed actually cuts, and the markets go, oh, that was too many, and we correct the other way. So this could be a similar thing this time, but if it's creeping into July, it's much more immediate. What are they afraid of?
I mean, I think it was Waller that said the July, and it's interesting because there's speculation of him being the successor to Powell, and it's like, is he playing into what President Trump wants? Is he kind of trying to juice his position up to get in line as the next Fed chair, or is he basing that solely on what he sees in the economy? But the SOFR rate, climbing pretty substantially just over the past 3 days. You have to kind of see that as the war risk being taken off. Because one of the risks was, an Iranian response to disrupting oil supply chains, which mostly through its proxies closing the Strait of Hormuz. And, when the ceasefire was negotiated, you saw those rates come up. So if there's less inflation pressure, that would open the door to an easier path of cutting rates. So that's one reason we've seen these rates, this SOFR rate increase over the past few days. So now it shifts back to how are the tariffs, when and if they're going to show through the economy. And it's not just the inflation we've seen. Not through the NFP, but through some other, indicators such as challenger job cuts and things like that, that, you know, there is some weakness building in the labor market, but it hasn't really reared its head through, you know, the NFP, which is ultimately what the market looks at when you're talking labor market strength or weakness. So, you know, we're getting closer to this next jobs report, which I think is, of course, going to be a big headline event that could shift these rate cut odds. But, you know, the fact that the market is kind of in conflict with the Fed's outlook, does the market rally on the market expectations? And if it continues to do that, and if the SOFR rating continues to increase, effectively meaning more rate cuts are coming, is the Fed going to start to push back on that in more of a visible way? It won't want the market to get too out of line with what it expects. So I think you have to do what you always do, which is watch the data as it comes in and, you know, capitalize on the divergence while it's here. And I certainly think, you know, a sell-off, like we said, isn't coming anytime soon. But if this SOFR rate, you know, if you watch this and it makes a substantial break to the downside, I think that would come alongside, you know, a reason for the market to do some selling. So I think you do what the Fed is doing, which is watching the data as it comes in, but ultimately rely on the price action in your trading.
Yeah, I mean, I think that's absolutely something I can get on board with. That the price action is going to tell you, and this is where it gets really, really interesting. To your point, Thomas, we had a kind of little pop over the past maybe few days in break-even rates. Now that oil has come off and that geopolitical element in kind of bidding up inflation, since that's unwound, those break-even rates are right back down. And one of the more interesting sort of disparities in markets here is those break-even rates basically have been falling all year until the beginning of April, where obviously there was a crescendo for all markets. And obviously stocks have since recovered, but break-even rates have not. And they're still sitting at these levels, basically scraping near the lows for where we were sort of early to mid-April, especially on the more time-sensitive, the more kind of immediate 5-year break-even. So while stocks and the break-evens were falling together from mid-February into April, stocks have obviously come all the way back. Break-evens have not, which sort of makes me think, and I'm not prepared to put any more exposure out there on this besides still being long the bonds. It seems to say that what stocks are showing is more sentiment powered, whereas what these break-evens are saying and what then the Fed funds futures, the SR3 futures are telling us is that the market still sees some kind of an economic headwind. It doesn't think that inflation is the issue. It thinks growth is the issue. And it thinks the Fed should be cutting. And it's screaming at them to do it. And the Fed is resisting. And ostensibly, you get to the end of a hype cycle and the market starts to notice. But to your point, Thomas, you probably need a catalyst for them to notice. So you're through the hype cycle of the tariff regime will collapse the U.S. role in global finance. We're off that concern. We've stepped back. We're off the concern that the U.S. and Iran are going to launch World War III. We're off that. Do we think the PCE numbers at the end of this week have some capacity to get us back to looking at why the markets and the Fed are at a crossroads and apparently thinking very different things here? Because the bonds, take a look at the continuous contract here where we can actually see something. There we go. The bonds are creeping higher here to kind of echo what we just saw in SR3, to echo what we see in Fed funds futures. So the bond market is sniffing something out here that maybe stocks haven't picked up on yet. Is this data going to do anything? Or do we have it benchmarked already?
I don't think so, because we're looking at a year-over-year estimate of 2.3%. Last month was 2.1%. So even if you rise to 2.3, that's not far enough outside the Fed's target where it's going to, take the focus off growth, like you said. So, we have the first week of July is going to be probably the biggest week to contain, any potential of a catalyst for volatility increasing, because it's the July 8th trade deadline for, most countries that we're negotiating with. You get the NFP. So I think even if this was a little on the high side for PCE, the market's quickly going to shift its focus into the first week of July, where you get some of these, either these trade deal pauses, deadlines, these self-imposed deadlines are pushed back a bit, like what we've seen already with China, or potentially the NFP comes in really weak. That would be a trigger. If you did get that, how does the market react to that? Because on one side, yes, the labor market weakened over the past month, but that also brings in the expectation for the Fed to cut rates sooner rather than later, which would, of course, translate to economic growth, but it would be, it takes time for those cuts to work its way into the economy, but it would signal that the Fed has now started the rate cut cycle and they're ready to act. And once you get one rate cut, you're more likely to get the follow-on rate cuts, because the center of gravity has now shifted for the Fed. So, I don't think the PCE is going to be as big of a concern for the markets as the following week is, where, trade and NFP numbers are in the picture.
Yeah, it seems like as it stands, I think the market is telling us maybe there's things that people are worrying about, but the market isn't necessarily worrying about it, and they're expecting that we're finally going to get some of these cuts, because these probabilities have shifted quite a bit over the last couple of weeks. And now looking at the December cycle, which is the last opportunity to make a decision, there is almost an 80% chance that we arrive at a 50 to 75 basis point reduction in the current rate. So, and it's actually leaning towards 3. It's leaning towards 350, 375, which is interesting. So maybe nothing happens in July, and then we get consecutive cuts in the next 3. And then that also might explain why there's only 1 for next year, if they're just front loading these based on softer data.
Yeah, I mean, if they front load everything, much like they did last year, right? So if they come out in September and go 50 basis points, and the markets go, whoa, okay, that's not what anybody thought was going to happen. Yeah, maybe that happens. I would say the biggest concern for markets here might not be a PCE number that's too high. It might be a PCE number that's too low. So if PCE comes out not at 2.3, but at like 2, then the markets would go, wait a second. Is the Fed going to see what we're saying here, or what? Because we've been telling them that inflation's not the issue. We're going the polar opposite direction that Fed officials are trying to take us. Is this enough? Will they finally notice now? Or are we just going to fiddle past the graveyard here? And if we do, how much more do you need to do to then catch up later? And that'll be an interesting conversation. Obviously, I think the critical input into this, and Thomas, you alluded to this earlier, and Mike, I think that's sort of front and center of what you're saying is there's kind of hypothetical risks out there, but clearly the markets are not concerned, and you can see just how not concerned they are, at least about the geopolitics, with this reversion in oil that has essentially come back basically to where it started. So if this was kind of where oil prices were at the end of the April spook, and they kind of established a range for themselves down here, and this is the holy moly with Iran and Israel, we're back. We're basically back to that incremental sort of fair value level. We just had some data out of the U.S. on inventories today, Thomas. I know you're watching this stuff like a hawk. It was another big decline. Almost over 5.5 million barrels from the overall inventory, and that's after over 11 million last time. Those are pretty big pulls from inventory, and obviously the price could not care less here. It's looking at Iran. Should we be looking for a bounce here? Does this data tell us that maybe the whole thing is washed out now, and we can get back to supply and demand?
Yeah, so I sold the 61.62 put spread for the August 15th contract. So I see prices going back to like 65, maybe as high as 70. So like you said, we had the 11 million barrel draw last week. For this week, which was June 20th, we had 5.8 million barrel draw. That's 11% below the 5-year average. You also had distillate stocks drop again. That's 20% below the 5-year average. You had gasoline stocks drop. So we're kind of coming into this peak summer demand season for gasoline, which is the 4th of July holiday. Then you get kind of, it levels off until September, where you start to get some weakness as the summer ends. But at the same time, so you have U.S. stocks drawing far more than estimates for the past 2 weeks. Like you said today, there's a small bounce in crude oil, but the market is still focused on, the geopolitical risk premium evaporating from this wild ride we've had over the past 2 weeks in oil prices. So I think now the traders are going to shift back to fundamentals. You're trading around 63 and some change. I think that's lower than where we should be. So, you get the OPEC saying they're going to produce more, but we haven't really seen that too much, and that's being led by Saudi Arabia, which is going to unwind more of their production. But at the same time, domestic demand in Saudi Arabia is up, so they can absorb some of those barrels that they're producing. So that's less going out into the global supply. So I think we're headed back up around 65 to 70. We kind of had moderation today after this bigger sell-off on the ceasefire news. So I think the selling is pretty much done here. And you have some swing levels from, April and May around 62, 63 that you could kind of play off, if you're doing a technical trade there. So we're at a zone of support after, these geopolitical tensions come out. You had a lot of shorts get whacked out of the market, over this past 2 weeks. So, kind of now positions are going to recalibrate. So I think traders are going to start getting long again. You see prices drift back up to 65 to 70 between that range. And then, you're looking next week at the EIA numbers again, which is going to be for June 27th. So the next 2 weeks, you're really looking at the EIA numbers where there's really strong gasoline demand in the U.S. You have OPEC, saying they're going to produce more, but it's not fully materializing yet. And then you have the threat of, Iranian oil being completely taken out of the market. That's removed. So China is going to continue buying Iranian oil. We had the truth or the tweet from Trump kind of, saying, China, you should be thanking me because you could still get your Iranian oil. By the way, we'd like it if you bought some U.S. oil as well. China hasn't really been a big buyer of U.S. oil this year, but you've still seen the exports quite strong. So I think playing for a neutral to bullish position here is kind of the prudent thing to do after you get the geopolitical tensions coming out of the market. You get this really quick 2-3 day sell-off that took us back to the levels where we were at the start of the 12-day war, the Iran-Israel conflict. So I think it's a good time to buy here.
So for the record, I sold MCL calls into this pullback on Monday, and that's worked great, but now it's obviously idling. So I'm sort of on the fence here of what to do next. I might just flip this off and step aside. There's still a good bit of vol here, so maybe something directionally neutral, like an iron condor or something like this, might make some sense. Mike, did you wade into these crude oil waters the past several days? What are you doing here?
I am standing by right now, but no, I did have an iron condor on through the whole thing. So I had the 61 short put spread and then the 70-71 short call spread in the July 17th cycle. And I just did nothing with it. I watched it fly through the call side, and then I saw the sell-offs, and now it just literally went right between the strikes at 65 and implied volatility got crushed. So that was a roller coaster, but it was a small defined risk trade. Ended up closing it for 80-cent winner. But I would like to get long oil now. If we get a little continuation of this move, I agree with Thomas. I think, in this range, 64 to 62-ish, I think is a decent buy spot. And if we get there, I'll just...
It seems to be right at support, yeah.
Yeah. So I'll just get there by way of the micro crude contract and just do one contract. I found that to be a nice way to get long exposure. You can do a covered call in there. You can sell a call spread in the main contract against it. But yeah, I'll be looking to buy in that 62 to 64 range. Ideally, we get a swift sell-off closer to 62, and I'll feel more comfortable with that.
Yeah, I mean, for me, if you look at it sort of intraday, I've got a 4-hour chart on here. This kind of becomes a trigger line of sorts where we have the big reaction and then we kind of carve out this range. So if we end up poking our way through to here, let's say on a 4-hour basis, 8-hour basis, so something that takes us in here somewhere, then yeah, I'm probably looking to just roll the position over into long side exposure and just do it like that. But the vol here is expensive, so I probably wouldn't do it by buying calls. I'd probably do it by selling puts and having that kind of kicker on it, because if this thing is going to respond to these inventory numbers like this, obviously there's a little bit of latency when everybody's focused on geopolitics and nobody's really focused on the underlying. But these are pretty substantial inventory pulls, so you could, I think, reasonably get a little bit of a bounce. Shifting gears here to another place where the action is indeed continuing. In the US dollar, this has not been a happy time trying to pick the reversal here in the dollar for me. I've been short all year, and then on Friday I flipped long, thinking this is maybe a top here, but maybe not. And certainly the building Fed rate cut expectations in the markets that we were talking about are at least one element in this conversation. But it looks like the euro is breaking out here. And that's something that is showing up across all kinds of different currencies. I mean, you can see the same thing in the pound here. There it is. Attempting to take out the high there. Not quite there in the Aussie, but this thing has been basically listless going all the way back to early May. Not great in the Canadian dollar, although not really making progress the other way either, and sort of anchored in the yen. So it appears to be a kind of dollar versus Europe move, and Europe seems to be winning. What do you guys think here? Am I still should I be running away from my long dollar position here? Because I am inclined. I think the price action is doing the wrong thing here. But at the same time, when I look at it over a longer term view here, there we go. Come on now. When I look at it, and let's see if maybe we can get a continuous contract here for a little more clarity. There we go. There is this big underside right here where there was a big range and we're sort of right there. Is this thing just attempting to stress the last bit on one side before it rolls over now? Or is it just going to keep powering higher? Are we going to 124 euro?
I was playing it, I think, the same way as you. Last week I sold the call spread at 117, 117.5. So I wasn't expecting us to breach this previous June swing high. So I'm on the wrong side right here. I think I'm going to hold on to this, though, for the levels you pointed out, and kind of perhaps a last gasp higher for the euro. On the other hand, you get like the NATO summit today, where you get this pledge by European countries to spend more on defense. So that right there is bullish. It could be bullish for the euro, because if you have more defense spending, that could feed into economic growth. It depends how the individual countries within Europe are going to do that. Are they going to try to raise more money to fuel this spending on defense, or are they going to try to find ways to fund it through cutting spending elsewhere? But that's a longer term implication, and I'm not sure if the NATO summit has too much to do with the move today. I think it's more kind of dollar weakness. But I'm going to hold on to this short call spread that I have for at least a couple more days, and hope that we reverse lower. If by Friday we keep rising, I'll just get out with a loss on it. But I've been doing long euro trades all year up until last week. I finally thought the dollar was at its point where it's bottomed, and that hasn't been the case. So I'm going to hold on to this for a couple more days, and then I'll abandon it and reassess next week if it's out. But for now, the short dollar trade is still working.
Yeah, my biggest exposure is the Japanese yen. So I'm long the yen dollar calendar spread. I'm long the 44-day 7.2 call, and I'm short the 8-day 7.2 call. That's pretty much a scratch right now, but that's definitely my biggest exposure. But wait, there's more. I also have within the tastyfx integration, I am
fun times. Welcome to the fun world of spot.
Oh yes. It's been real fun. I'm losing in every position I have. It's been great. I'm short the Aussie dollar, very small. I'm long the dollar franc, very small. I am short the dollar yen, very small. And today I got long the dollar Israeli shekel for kind of a very direct exposure. And yeah, all that's extremely small. Like all those positions combined they've all moved like 70 cents. But the Japanese yen calendar spread is definitely my biggest position. But I'm all over the place. I'm just waiting for something to move.
So here, from this wonderful integration of spot into the platform is the U.S. dollar Israeli shekel. We can see the shekel is off to the races here. Not anything I'm trading. I usually keep myself to the majors when I trade spot FX, but I trade spot FX all the time. In fact, all of my exposure this year to the yen has been through spot FX, and most of it has been short dollars. Really, because you can get a lot more flexibility in terms of smaller position size, so you can manage risk a little bit more granular than the full 6J contract, which is huge. And so I've been doing that, but interesting spot here for the shekel. Let's see if we can, is that all the back data that we have here? Looks like it. So if we look at where we are here, we're at a pretty significant level. So if you were looking for a US dollar rebound, and for whatever reason your indicator for it was this particular exchange rate, you might say, well, hold on now. Do we maybe have a line in the sand here that's approaching right around here? So interesting to consider. As far as USD franc, let's see here if we can get that up on the screen. No, not seeing it.
Yeah, it's the USD CHF.
Right.
But yeah, that is.
See if we
that one is
there we go.
There you go. That one's even more multi-year extreme. The shekel was a 2-year price extreme. This one is got to go way further back. You got to go back to 2015. That it's kind of crazy.
Yeah, I mean, here is a chart here of where we are. By the way, note these awesome charts now in the tastyfx tab of the platform. I'm kind of still angling to the idea that maybe the dollar has some kind of a bottoming that's occurring here. Seems to be kind of testing the last line of defense. Looks a little bit better here on dollar Swiss than on the euro, where obviously there and the pound there's already been a breakout, and maybe we're not giving this NATO summit enough due, Thomas. Maybe that's sort of why the pound and the euro are jumpier today, because and obviously, I mean, Switzerland is not exactly expected to beef up their defenses, and they're not a NATO country, and that's sort of not their whole vibe. So maybe that's what this is. But if the Fed is right and we're not going to have a lot of rate cuts, then the dollar seems awfully cheap. But the markets are clearly sort of screaming in the opposite direction. So it seems like somebody's going to have to convince somebody of something. And between now and the end of the week, really, it's the PCE data that's on my mind, and not in the sense that it might be higher, but rather in the sense that it might miss. That's really been the trend for U.S. economic data recently. In fact, over the past month or so, it's increasingly turned out soggy results relative to forecasts. And so kind of thinking about, if the market is right and the Fed is wrong, then we're in a situation where this data might miss, the market's outlook might start looking more appropriate, and then we might hear a different message from the Fed in July, which is going to be difficult to send, Thomas, to your point, because you have these deadlines, and the view on tariffs has not clarified significantly. Anything else you guys are looking at in our last 5 minutes before the end of the week? Those of us that are macro degenerates really only have the PCE number to hang our hat on, maybe durable goods tomorrow. What are you guys looking at? And by all means, take us anywhere on the board here. What are you watching before the weekend?
So I'm watching for tomorrow nat gas, because we have the EIA numbers for nat gas, and we've had a pretty big sell-off in the product over the past week. So we're trading kind of, we have this kind of support level, this trend line that we get off the April swing low, and we're trading right near that. The past 4 days, we've had a really good sell-off. We've gone from around 4.2, now we're trading around 3.6. So we've had a lot of retail longs washed out in their positions. We're near this support level, and we got the EIA numbers tomorrow. I think the median survey estimate is around an 88 billion cubic feet build. So, those numbers come out tomorrow. We've had this extreme heat. Perhaps the build could be less. Of course, if it comes in under, that's bullish. But is it going to be seen as kind of a risk clearing thing, regardless of what the numbers are? And are we going to revert higher and stay within this range that we've been trading in between April and May, all the way from 3.4 to 4.2? I think we stay in here. So that's kind of, I have a trade on right now. If I wasn't long, I'd get long right now. But my nat gas position, I have a short put spread at 3.25, 3.3. So I feel pretty comfortable with that, even though we've drifted lower. And I'm also selling the call spread at 4.5, 4.6, which I've been in for 2 weeks now. So that call side has been doing a lot better than the short side, but I totally expect us to stay within that 3.3 to 4.5 range, but now with upside bias, since we're near the lower end of the range here. And the thing is, there's been this extreme heat wave right across the East Coast, where a lot of natural gas demand is concentrated, and yet we've sold off. So part of that is the war resolving, but also part of that is if you look at displacement of natural gas demand from things like solar and wind, along with this heat wave, it's been really windy and really sunny. So that has displaced a lot of that demand for natural gas. And that's why these numbers may come in on the higher side, despite, a pretty substantial heat wave. So the EIA numbers, regardless of what they are tomorrow, I think we're going to find some upside pretty soon. And that's how I'm positioned. So that's how I'm playing natty gas.
Yeah, that was my first look too. But outside of that, I think it would be interesting to see if oil moves in a big way. It's not projected to, given the volatility collapse, but I think Bitcoin's another one. Bitcoin is the only thing that's like continuously moving through this rally here. This is the third consecutive day relative to the E-minis and NASDAQ. So yeah, I think there's some things that could push or pull the market, or maybe give us an indicator of what's to come.
It's an interesting thing in Bitcoin here, because you'd think the dollar is getting shellacked, there's risk on, and you're still kind of stuck in this lower highs and lower lows thing, which is a little bit interesting. Now, if you were completely price ticker agnostic and you were just looking at the chart, think you might say, here is a digestion, kind of a pennant flag triangle type of thing. Pick your favorite technical analysis term, but it looks like a consolidation that gives way as a continuation setup where this is the trend to continue. And so the bias normally sort of on pure technical grounds here would be to break higher this way. But you don't have it yet. So it's an interesting thing here because we seem to have attempted to break out, then we didn't. So we take a look at what we did with these highs here. We sort of attempted to get north of it, then failed. And this basically becomes the line in the sand, where if you can close above 110K or so, you might have the next big run. But for now, it's kind of, it appears confused.
Yeah, and I would say that aligns with the rest of the market not moving.
Yeah.
Chopping.
And generally confused there too.
Yes.
And on that encouraging note, overtime is out of time. Thank you, gentlemen, for filling in. Always a pleasure to have you. Tasty Live After Hours continues. You can cue the sexy music right there. Although nothing of the sort is coming next. It's me with macro money and a bunch of long discussion of complicated charts. So stay tuned. We'll be right back.
Dear Kaylee, hats off to you for being such a culinary genius. I don't think it has ever dawned on our kitchen staff to serve gazpacho hot. Sincerely, Bob.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
I don't want to fact check you with my vagina, but I will.
From the smart mouths at Tasty Live.
If you missed the live show, here's our cherry on top yearly recap.
Breaking news on Instagram. The first segment of your line dancing has been posted. Left together, switch, turn. Right together, twirl, turn. Hip, hip, hip.
Right together, spin, clap. Left together, spin, clap. Hitch, 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 turn, shuffle, rock, shuffle, rock, shimmies. Shimmy.
I took 5 lessons for Casey's wedding, and all I knew how to do was
Right together, spin it around. Yup. And you want to clap. And then like strut down, Right together, spin. Left together, spin. Hitch. Hitch, cross, turn, shuffle, lead, shuffle, rock, shimmy, lasso.
this is not good.
Hey! Oh, he's got the walk down. He's got it down.
Perfect. And you got the bed. You got everything.
That is not even close.
God, bitch stole my oh, it's flawless.
Look, it's beautiful.
Flawless.
No.
You're walking way too fast.
And go stick your finger in all of our lunches.
Now complain about something.
Oh, God.
You watched the debate, you knew who won, and you just didn't want to admit it.
I was in New York. I was flying home that night, and I'm so sorry that I didn't go back and tape the vice presidential debate.
First of all, I think it's hilarious that you run a technology company and you still think you think you had to tape it in order to watch it. You think you have to tape it?
He didn't have a blank VHS tape to spare for the debate. Stas, what comes up next? The opening bell. Don't look so surprised, Sadlov. It's been this way since 1980 when you first started trading. Wait a minute, was it always 8:30? Yes, the opening always was the same. The closing has changed.
What has changed? I don't think so. Nothing's changed. The only thing they did, I think, was add the 15 minutes.
Excuse me?
The only thing I ever think that changed was the 15-minute curb session.
From 3 to 3:15, so they did change it. So it was the closing and not the opening that's changed.
For option traders, the 15 minutes.
Well, listen. We're not being traders here.
Do not engage.
When I got,
we didn't, wait a minute. So
when I got in this business,
we used to open it at 9 o'clock. Since 1980 to now, we didn't always open at 8:30 in the morning.
Yes, we did. Is that at $20?
I am going to get this $20 off of you.
I don't think so.
No matter what. Chris, how are you, my friend? Chris, your job after you get off the show here is to find out when the New York Stock Exchange opened in the 1980s, what time they rang the bell. I have a $20 bet with Sosnoff. We're going to be eating good tonight. I already decided that Sosnoff will be having cereal for dinner tonight. I said the New York Stock Exchange did not open at 8:30 Central Standard Time. It opened at a different time. Saz said it always opened at 8:30.
I already have the answer. You guys need to choose a year, and that will determine which one of you is correct.
No. I've already won this. I said from 1980 to now, 2024, we didn't always open at 8:30.
I gave him 1980, but I technically didn't start probably till 81. But go ahead. What is it?
September 1985 is when it switched to 9:30 a.m. Eastern.
Thank you very much. Thank you very, very much.
Not 1980. Not 1980.
I remember. I was on the floor. I was working because I would have to get up earlier in the morning.
In 1980, the New York Stock Exchange opened up at 10 a.m. Eastern. It closed at 3:30 p.m. Eastern Time. The schedule was in place until September 1985, when the opening time was changed to 9:30 a.m. Eastern.
Pay me, bitch!
Get the full scoop by checking out the archives at tastylive.com.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tasty Trade. Make your move.
If you had to buy and hold one stock for the next 365 days, what would it be and why? If you had to buy and hold one stock for the next 365 days, what would it be?
Aside from our own company. So if I had to buy one stock from now, 1 year from now, that might go up on a percentage wise, I think I'd buy Intel. I know you're going to hate that. I know everybody's going to hate that, but it's a $20 stock that I think is going to go to like 25. It's a nice little 25% kicker. If I had to buy another stock that's like in the same price range, I kind of like Southwest Airlines here.
Gosh, I know it's such a divisive stock, but I would say NVIDIA. It's just one of those interesting names that I think is sort of forward-looking, and the stuff that they're doing with chips and obviously the AI revolution. I've always thought that was fascinating. So it is definitely one that I think is here for the long term, and that's one that's interesting to me.
Tom said Intel. You have any thoughts?
Well, that would make sense. Tom is an Intel type of person. I mean, Intel started what year?
So I studied economics and international relations, and I wanted to do the hands-on rather than the academic version of that, and the most natural thing was global macro investing. I begin with a sense of where I think the overall direction is for the macro theme for the next 6 to 12 months, and then look at some basic response from the price action to see how it's going. I think the price itself is the purest of indicator. It subsumes within it the collective emotions of the market. One of my favorite mottos, if you will, comes from the always great Ira Harris, who said, if you're right at the wrong time, you're wrong. And so, for me, every macro narrative begins with what's the price action saying, rather than this or that economic indicator or some such thing.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Well, we have another day of testimony from Fed Chair Jerome Powell, and the dust seems to be settling on the ceasefire between the U.S., Israel, and Iran. It seems to be holding for the moment. So what do the markets look to now to animate next steps? That's what we're going to try to unpack here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And the thing that continues to stand out as we digest all of this tremendous volatility over recent days with all of the various headlines from this corner and that all across the spectrum here, be it geopolitics, be it the Fed outlook. The thing that stands out here more than anything is still this disparity between what the Fed is seeing and what the markets are telling them they ought to see. And now that we've had a little bit of a settling on the geopolitics story, we have an interesting opportunity perhaps to begin to make our way toward a resolution. And the markets tellingly stall at an interesting spot here. And now this is the continuous contract on the S&P 500, just to give us a bit of a benchmark. We have basically a hold here, but of course these are not the tradable contract levels. So here we're more looking theme-wise than we are at, for example, the current active contract on ES, which would be the September U contract. So we're at this decisive level on the continuous, but more importantly, we have these 2 days of significant response to geopolitics. We start the week with a gap down after the U.S. strikes Iran. Then there's the effort to de-escalate that ultimately gives us a rally. And then yesterday, when the ceasefire is basically forced by the U.S. onto Israel and Iran, and they begrudgingly agree, we get this push higher. And that basically puts us in the same digestive range where we were since early December of last year and into mid-February, where concerns about the impact of the tariffs on business confidence and consumer confidence start a growth scare and give us a sell-off that, of course, ends in the crescendo that was Liberation Day and its prompt flip-flop right here. So we look then to a situation across markets today where the geopolitics have seemingly gone to the back burner, and the markets are unsure of what to do with themselves because they don't appear to go very far at all. S&P ends the day flat. NASDAQ ends the day with a little bit of a gain, 0.22%. Russell, the small cap index, down 1.13%, but nothing really running away. Crude oil, tellingly, down about 0.5%, a little bit less, but certainly nothing like the huge moves we've seen over recent days. Monday's was an 8.6% downswing, followed by a further 3.5% decline on Tuesday. By any kind of reasonable comparison, we're not going anywhere today, just kind of idling here around the 63.50 level on the September CL contract. Gold prices stuck here today, up a touch, about 0.25% after yesterday falling 1.65%. So the name of the game here seems to be digestion. Probably the most interesting bit on the board is a significantly weaker U.S. dollar, which against an average of its major counterparts has now fallen to the weakest level since April 2022. And the biggest moves here against the European currencies, dollar down 0.42% against the euro, down 0.3% against the pound, and for the most part weaker across the board. It's a little bit higher against the yen, but even there it's modest. Otherwise, the dollar is for the most part lower. And where that seems to fall is not so much the geopolitics of the story, where, again, the sensitive assets here seem to have stalled to think things over, but the second day of testimony from Fed Chair Jerome Powell, where the message is a familiar one. Of course, we had the meat of the testimony yesterday. The prepared remarks were just about the same this time around, but few more additional comments came up in the Q&A. Probably the key thing here is that the Fed does not want to give a lot of forward guidance, and seems to think that it makes sense to move slowly amid uncertainty. This is very much the story that we heard from Fed Chair Powell yesterday. It's likewise very much the story that we heard from the FOMC announcement last week. This idea that the Fed is not sure what to do around what the impact of the tariffs is going to be. Powell, in fact, said very clearly yesterday that the Fed might have been cutting by now this year, were the tariffs not to have created a lot of uncertainty on the path for inflation and for growth. And of course, we saw this in the adjusting of the Fed's growth and inflation expectations in the summary of economic projections they published last week. We can see here growth revised down, unemployment rate revised higher to match that, the inflation outlook revised higher both for headline and core. And around this uncertainty, the Fed seems to have said that they're going to push out making rate cut decisions further. So we still have 50 basis points down from 4.4 to 3.9 on the menu for this year. That much remained unchanged. But for next year, we can see we've shed a cut. It's now 3.6 versus 3.4, so that's one less cut from 2 down to 1. And now we have to wait until 2027 to get to 3.4. So it's not like things pick up thereafter. It's not like there's a hump. The Fed is seeing fewer rate cuts across the outlook. And if we look at how the markets compare, and this is where that dollar weakness comes in, they are squarely moving in the opposite direction. The outlook from the markets has become increasingly more dovish. In fact, it's become more dovish both for this year and for next. For this year, for the most part, we're still in line with the Fed's forecast, a little bit more dovish, maybe only 6 basis points. But the outlook for next year is substantially removed from what the Fed is thinking. So if the Fed is only envisioning 25 basis points right here for next year, the market is saying 60. In other words, not only is the Fed likely, according to what the markets think, end up doing not 1 but 2 cuts, but they have about a 50-50 shot of doing 3. And so this is where things get the most interesting. Because while stocks were, as we just said, sort of mixed to idling, a little bit weaker on the small caps, a little bit stronger on tech, giving us an S&P 500 on net that doesn't go anywhere. We obviously have a slowdown in oil. It's cooling to digest. Gold is cooling to digest. The dollar was on the move today. And so, to some extent, were bonds. The 10-year note here closing at the highest level that we've seen since the beginning of May. So yields are coming in, and that seems to echo what's going on here, which is the market is pointedly going in a different direction. Moreover, it's not just for last year. If we take a look at the rate cut probabilities, even for this July meeting, we can see that a month ago, the markets were much more concerned. But what we look at a week ago, they were much more certain that there will not be a cut in this upcoming July meeting. But what we can see is that the probabilities are starting to shift here to where now the market actually sees the chance that there is a rate cut at this July meeting at about 25%. Now, of course, that's still 75% in favor of standstill, but we can clearly see that now the chance that you get a cut versus standstill is higher. That is, a chance of a hold is lower than it was yesterday or a week ago. And so even in the immediate layout here for rate cut probabilities, you're still seeing this sort of more dovish tone. And it gets even more significant when you look at September. Now here, of course, the cut is expected to begin with a likelihood approaching 70%. But what's interesting here is that the likelihood of a hold has diminished. And instead of that going into here, we see that the probability that you by then will have had a second cut, that's building. And we can see that this is starting to look interesting because for July now, it's over 20%, approaching 25% that you get a cut. And now you're at 20%, which is, again, small but not insignificant, that there is a second cut in September. So the markets are very clearly saying that they're not buying what the Fed is selling. And as ever, the story seems to be about inflation. We've talked about this disparity, and it's only become more festering as all of this geopolitics concern has washed out of the markets. This is the S&P 500 here, of course, in the yellow. These are inflation expectations baked into the bond market by taking the difference between nominal and inflation adjusted or real rates to extract the inflation adjustment itself that takes you from nominal to real. And that gives you a sense of what the bond market is pricing for inflation. And you can see here at the beginning of the year, we had, of course, that growth scare that we just talked about. That's this move right here. And against that backdrop, inflation expectations were falling with stocks because the concern was, oh no, the rollout of these tariffs is hurting business confidence and consumer confidence. It's going to end up in the business cycle. It's going to hurt growth. And they moved in tandem. Stocks have, of course, rebounded. Inflation expectations never did. And after this little shakeout with the spike in crude oil prices bidding up inflation only a bit, as crude oil has reversed, so too have inflation expectations. And so we're in a situation here where the Fed seems confused as to whether it should prioritize fighting inflation or cutting rates to boost the economy. The markets don't seem to have that confusion. They seem to think inflation is not a concern and that the Fed really ought to be cutting already. And the divergence there is becoming increasingly acute. Now, there's not a whole lot of economic data to try to get a catalyst for a resolution, but before the end of the week here, we're going to get the Fed's favored measure of inflation, the PCE index, where the expectation is that we're going to get a little bit of a pop. The headline rate seen rising to 2.3%. That's up from 2.1. And the core reading, and this is the one that the Fed cares the most about because, of course, as we can see here, most inflation is stuck still in core services. And in any case, the Fed doesn't have much agency over global food and energy costs. That reading is expected to edge up here to 2.6%. Encouragingly, that would still be the second lowest reading since March 2021 after April's 2.5%. But nevertheless, it would be a travel in the wrong direction, as it were. If we look at the benchmark Cleveland Fed's forecast, their kind of running tally of what inflation is likely to be, we can see it basically lines up with these forecasts. So we can see their model here is at about 2.3 for the next reading and about steady for the core. So that generally comports with what we're seeing here. It's maybe a little bit off on the core, a little bit lighter there, but for the most part, it looks like there's a consensus around these numbers. And generally speaking, the PCE report is pretty well benchmarked by the markets because by the time they get the CPI and PPI numbers, they can extract the relevant components, reconstruct a PCE model, and get very, very close. So deviations here are not usual. Nevertheless, it is important to note that, at least in the case of CPI, it did surprise on the low side when it came out. Now, inflation still ticked up, but less so than expected. And in this case, we'll see perhaps more of a market response given how we're positioning, where the markets are leaning more dovish and the Fed is attempting to fight that. You probably get more of a response in the event of a surprise lower than a surprise higher, because it would suggest that the markets really are onto something and the Fed is off sides. Now, to give the Fed their due, we can see here that last year when inflation had a little bit of a melt up and the Fed was concerned that it needs to stop cutting until it's clear that things are not going off course. After we saw that melt up peaking, this is March, it took us all the way here to September to actually get the Fed to cut rates. Now, we've only had 3 months off the peak here. Maybe we'll get a fourth. These up here are the 3-month and 6-month annualized changes to give us a little bit of a sense for how the Fed looks at inflation dynamics beyond just year-on-year and month-on-month readings. And so if we are anywhere in this cycle like we were in this one, then we are somewhere here. And that, of course, gives us another, 1, 2, 3, 4 months for the Fed to mull things over. And indeed, July, despite the recent shifting in the odds here, we can see the Fed is still mostly expected to hold rates unchanged. There's no meeting in August. And so by the time we get to September, we've already exhausted at least 3 more months in this sequence. So perhaps we're just following a familiar script. Likewise, in the Fed's defense here, we also see that the leading ISM index on prices would imply that PCE and CPI are heading higher with about a 2-month lag. However, U.S. economic data has tended to underperform increasingly relative to expectations. And that's, of course, a contrast with the rest of the global economy. So there is this sense that the markets are not seeing a mirage here, and that, in fact, inflation is being pressured lower by a weakening economy, which, if we consider how much the U.S. economy contributes to the overall pie, the majority, and that it is, at this point, the only engine of global growth that isn't stuck in stall mode, which is where both the Eurozone and China appear to be, hugging this 50 line, which is neither growth nor contraction on composite PMIs, whereas the U.S. at well over 50 is clearly in growth mode, gives us a story where this is the only part of the pie that's growing, and also the only part of the pie that's meaningfully weakening. So the markets might be onto something here. So if the PCE numbers actually come out lower than expected, then perhaps the Fed is going to look increasingly wrong. And if that's the case, well, then we might get still more US dollar weakening, still more dovish repositioning, still higher on the bonds, and then whether stocks can finally focus away from geopolitics and on the business cycle and consider that the bond market is screaming at them that something appears to be misfiring, that remains to be seen. And with that, we have macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Chris for Futures Power Hour on Friday. This show returns tomorrow. If you're watching on YouTube, like and subscribe. In the meantime, happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
The future of trading is here.
Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
All right, Tony, we have a big week of earnings coming ahead and in a time of high volatility and uncertainty. How are you choosing to attack this week of earnings, and do you think that there's anything that traders should be aware of?
I think earnings become less important when you have volatility in the overall market, because sometimes a lot easier to find a higher probability trade in a longer dated time frame than you would for earnings. But if you are going to trade earnings, I think you have to trade it much shorter term and probably directional. And with this implied volatility being so high, it's going to be even higher in these earnings trades, which means that all options are going to be priced a lot more fatter. And if they're fatter and you're selling them, then you can get a higher probability of success and be further out. So I think you have to trade them directional, and I think you have to trade them shorter term for earnings themselves if you're using options.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
What's one under-the-radar stock that you think could have a really good summer this year?
Oh, man.
Oh, man.
Good summer, man. It's funny, immediately when you ask that question, I'm like, I don't really pay much attention to underrated stocks. And then I thought about CoreWeave, CRWV. That stock seems like it has a little thing to it right about now. I think it's one to keep an eye on.
I think Cameco, CCJ. I really like uranium mining. This administration is pushing forward a lot of efforts to cut some red tape, make it easier to invest in things like small modular reactors and stuff. So that's going to drive uranium demand. I really like Cameco.
I'm coming up a little bit short, to be quite honest. I feel like I want to get long some more stuff, but I've been having a tough time based on the recent rally that we've had. Come back and ask me that one again in a couple more weeks.
Maybe the Russell. I mean, the Russell still has underperformed the overall indices. Individual stocks, I think everything's pretty fairly priced right at the moment.
Could go a lot of ways. I'm looking at Budweiser. I'll personally contribute to their stock this summer, but that's all I can do at this point.
If you missed the live show, here's our cherry on top weekly recap.
Hola!
Look at you guys looking like spy versus spy.
I'm in the UK. Vanetta, I got in. They let me in.
So how's the vibe in London? How's the weather? What's the tea?
So Britt and I are getting off the plane. We're like, should we wait for Batista's? And I'm like, she's like, should we wait for the Batista's? It's the right thing to do. And I'm like, all right, yeah. And it's like European vacation. We are traveling with that, with that crew. So I have a little suitcase and a backpack. Britt has a little suitcase and a backpack. The Batista's, 75 bags. It's like coming to America.
We have a rule in the Batista house. The wife has to pay for the vacation when we're on vacation. So she has one suitcase full of shoes. So we need to just...
She's paying it forward.
She's paying it forward.
Then why does your son need a suitcase that's bigger than me? So anyway,
Vinny's frosted tips aren't gonna frost themselves. He needs hair products.
Against everybody else, because I didn't want to embarrass him in front of his wife. Everybody else knows the rule. If you check bags, we're leaving you.
That's right.
You get left behind.
You get left behind.
You get left behind. You get left behind. That's the rule. An hour later, we're sitting there like, oh my God, They're coming off one bag at a time.
It was about 45. You know, like Tom, we're traveling with Tom. We didn't get into the concierge level. We sat in coach. We're sitting on a train.
So anyway, we made it. We took the train. Then I had to walk. Britt made me walk like a mile.
Then it should be nothing. A big, strong man like
You should have carried it. I've never seen it before on a train. There were women getting up for him and saying, "Will you please sit? Would you like my seat?"
I mean,
seriously.
To be fair, when he starts lurching, it's jarring if you're not used to it.
Good morning, you knuckleheads, and welcome back to the show, Tasty Live.
That was kind of low.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tasty Trade. Make your move.
All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, Greg Magadini, fan favorite and director of derivatives at Amber Data. Greg, how you doing?
Doing well. Thanks for having me on again, Ryan.
Absolutely. It's a pleasure to have you on this show. I think everybody in the YouTube chat enjoys it as well. And so if you're not streaming on YouTube, get over there, type some crazy shit into the chat, or maybe more appropriately, if you have a question for Greg, maybe ask in the chat. We're going to go everywhere here today and really focus on some options, trade ideas, if you will, in crypto, not necessarily just in crypto, but also in some of the recent IPOs and other stocks that you can trade here as well. So excited to have you on the show as always, Greg. Let's just get into it. We've had Bitcoin chopping around a little bit, I suppose is how you would describe it. Took a peak below 100 real quick and right back here to, well, I've got 107 on the screen at the moment, but about 108 or so, kind of flirting with those prior all-time highs. What do you make of the resiliency of Bitcoin here? There's still a little bit of a positive correlation when you look at this across assets, specifically equities. You've got just massive geopolitical risk on the rise, and maybe that arguably has been somewhat subdued recently. But typically, you'd look at what's going on and you'd think, okay, risk assets are going to be lower. Bitcoin's going to be lower at a higher volatility. And yet, maybe it doesn't matter. What do you think?
Yeah, I always view Bitcoin as half kind of risk off, digital gold sort of behavior. And then other half is kind of the risk on trade. Ethereum, I view clearly more as the risk on trade. But I think overall what we're seeing in Bitcoin right now is just a steady trend higher, kind of the low volatility grind higher, which in my mind is a very constructive type of market. It isn't a wild spike higher that gets faded all the way back down a couple months later. It's more of like this constructive, call it 2010 to 2012 sort of bull market, low volatility that we saw in the indices coming out of the recession. So I think this is all constructive. The fact that prices quickly bounced off that 100K level, which is a psychological level that a lot of people look at, is also constructive. And I think this sort of maturity of the asset class or the asset of Bitcoin itself coincides with that lower volatility. So to me, the trend is unbroken here. It's only reaffirmed. If I look at the chart, it looks like a strong trend. And if I look at volatility, unfortunately, volatility for vol buyers has been realized has been underperforming implied consistently here.
Yeah, we're continuing to see implied kind of leak lower here as well. I mean, do you think, and we've talked about this a little bit on prior shows, do you think that's a function of some of these new participants that are coming in and overwriting calls against positions? You have a lot of participation in the ETFs. You obviously have much, much bigger participants as well that could result in some dampened volatility just given how they, I guess, behave in the market. But what do you think, I suppose, is behind the fact that we're at a yearly low or near a yearly low in Bitcoin implied volatility? And for context for everybody, that's going to be right around 40%. I think I saw 38%, depending on how you measure it on a 30-day basis. But, the other side of that, you could be back at 60%. So volatility is very low. What do you think is driving it lower here?
Yeah, I think it's maturing of the asset class. So if you think about Bitcoin volatility a couple of years back, or Q4 2020 when we finally broke above 10K all the way up to 36K. The participant base back then was more retail focused, and so you had a lot more of this sort of FOMO market that you see in some of the Wall Street names or the meme stock names, and you had a smaller market cap. So back then, the market cap, was a fourth of what it is now, if less than that, if not less than that. So it takes less money to move it around. Now we have a couple $1 trillion of market cap in Bitcoin. It just takes more money to move it around. And as you pointed out, we have a different investor base. We don't have the FOMO investor base that we would have with just pure retail. We have sort of this institutional investor base as well, which, like you said, their typical trading flows are buy the asset, sell the call against it for yield, maybe buy a put for protection. All of those things are volatility dampening effects.
Yeah, your, I don't know if I'd go so far as to say nation states, but maybe sovereign wealth funds that are possibly starting to participate are going to act a little bit differently than me, just smashing the button, of course. We have a lot of people already in the chat talking about different trade ideas here, some of the different instruments, mentioning, of course, the Amber Data newsletter that you put out. And I believe you do that on a weekly basis. So everybody should go and sign up for that if they haven't. I want to hit on something that that you spent some time on in the newsletter recently, and that's the Circle IPO. You had 5 or 6 points around this. I think you have a really interesting view here. Can you talk us through the Circle IPO and maybe some related trade ideas, given stable coins are just about everywhere right now? It seems like we've got legislation that's making its way through Congress, bipartisan support. Presumably, this is going to lead to more crypto adoption. But Circle's one of the few companies that you can invest in, or at least few U.S. companies that are publicly traded. Just went public recently, to the moon, essentially. How are you thinking about it, and where do you think we go from here? Is this just IPO hype, or does this have legs?
Yeah, I do not think it's just IPO hype. It's very tempting to say that because, the price has rallied so much so fast. But to me, I think this IPO was just priced low. And so how do you think, or how I think about Circle valuation is, instead of looking at Circle as a company, I'll compare the market cap to other cryptos. So, the Circle valuation market cap today is around 50 billion, despite the massive rally we've done. If we look at Ethereum, that's about 300 billion. If we look at XRP, that's about 125 billion. The reason I look at those names is that Ethereum, again, is more of that Web3 play, while Web3 is very highly correlated to Circle or stablecoin usage. We're thinking about DEXs, we're thinking about decentralized applications. A lot of the payment mechanisms are in stablecoins on those products. And then if we look at XRP, that's kind of more of a pure play sort of payment value proposition. And again, XRP is trading almost 2.5 times the valuation of Circle. And Circle is chain agnostic. So USDC lives on Solana, it lives on Ethereum, it lives on Tron, it lives on Sui, all these major blockchains. Well, if I'm making a bet on Web3, I kind of view stablecoins as half of the equation. So that almost, to me, the proper valuation is comparable blockchains. And so if we're going to have Circle be equal to Ethereum, that's 300 billion versus 50 billion. There's a lot of room for Circle to run up from here, and that's against one blockchain, admittedly the second biggest, but still one blockchain. And then if we expand out of that, I do view Circle as more than just a Web3 play. I also view it as cash in the Web2 world. Think about buying things on eBay or on Amazon and things like that. I definitely think that that's going to be a future addressable market for USDC. And then the last kind of point here is that the main competitor of Circle is Tether. And Tether is about twice the size of Circle right now in terms of outstanding stablecoin. But the way that the Genius bill is written is actually kind of building a moat around USDC. USDC is already compliant. They're already audited. They already have one-to-one proven reserves. And then they are also barred from paying out interest to USDC holders. So that essentially kind of preserves their income from being invested in U.S. treasuries. And then last point here, I know I'm speaking a lot, but last point is that the U.S. Treasury funding mechanism, if the fact that Circle is essentially buying short-term paper, that makes it a partnership with the federal government, so to speak. And if we look at outstanding Treasury bills today, it's about $7.5 trillion. So outstanding USDC is 60 billion. So in my mind, there's a lot of room to grow, and it's one of those things that no one can predict how big it can get.
Yeah, I would think, at a minimum, right, you have stablecoin aggregate market cap at, let's say, about 250 billion here today. That's at an all-time high, and that's across all chains and all stablecoins. And as you mentioned, Tether is the largest. I think if you look at it from the Tether market cap dominance perspective, it's 60, 70%, somewhere around there. So possibly you'll see USDC grow. But let's just say that we go from 250 billion to $1 trillion by the end of the decade. I don't think that that's unreasonable. And what you've described here, I wasn't really thinking about it in terms of that two-pronged approach, because obviously on one hand, makes a ton of sense that if you believe DeFi is going to grow, well, that's a function of stablecoin growth and vice versa. And then also, This is a superior funding mechanism. We're about to launch stablecoin funding, both deposits and then also withdrawals on the tastytrade broker side of things. Again, superior funding mechanism. And I think you're going to see everybody follow suit once things are in place here from the kind of more regulatory side of things. But I'm curious, do you think that the first mover advantage, or let's consider both Tether and USDC as the first mover here, they've been around the longest, they have the largest adoption. How important is that, or how relevant is it in a world where you likely could see, I would think, a JP Morgan launch a stable coin, or you would have competition from a lot of legacy financial services providers here, given there's a framework, and they've probably just been waiting for that over the last couple of years. How important is that first mover advantage in your opinion?
Yeah, so I think in terms of the Web3 world, Tether and Circle definitely have a strong first mover advantage, and it's a lot easier for them to protect that. They're already integrated in all the exchanges, all the DeFi applications and things like that. The Web 2 world, like stablecoin payments, buying stuff on eBay, things like that, I think that's where new entrants will have more of a competitive advantage, such as JP Morgan and stuff, and maybe Visa or MasterCard or whatever it is. I think they'll have a stronger advantage there. But let's see how it plays out. I definitely think the Web3 sort of stronghold, it's going to be hard to dislodge Tether and Circle from there, but I do think Circle is going to dislodge Tether because they have a first mover advantage on regulatory compliance.
It's a great point. And I think when you look at the market today, there really isn't any evidence of other stable coins that have come out really eating into USDC's market cap or Tether. PayPal has a stable coin, but does it matter? Maybe it will in the future, but certainly isn't used in DeFi, in my opinion. So
that's right.
That said, Greg, how are you thinking about a trading opportunity here, the setup? I'm looking at a chart here. I've got the last few weeks since the IPO. Maybe I can get down to a daily, a little bit better view. Or no, I guess it's only been around for a couple days. Let's see. Here we go. Okay. Got to zoom out a little bit. First day with my new hands, as we like to say. But basically went public at $60, ran to 300, and inevitably we've seen a little bit of profit taking here. How do you think about price action in something like this? Volatility's through the roof, pretty juicy option premiums from what I can see. If I jump over to the option chain, we'll just open up the July expiration here. $200 underlying, and the at the money calls are 10% of the price. How are you thinking about a trade setup here?
Yep. So first, I want to talk about the source of the volatility. So there's two types of kind of fundamental valuations that create volatility. One is sort of a junk stock that gets squeezed higher and it will eventually just crash back down. So that's one bucket. The other bucket in my mind is something that was underpriced that just ramps up to more of an equilibrium level. I think that's where Circle is. So I don't expect a pump and dump, so to speak, scheme with Circle. I view it as a legitimate equity. Now, the way that I like to think about that is I actually do want to own the stock, and I don't want to like chase it here and essentially buy the highs. So I think really selling that cash secured put is a very interesting way to get some action here. If we look at the implied volatility, I have a term structure on Monday. I could see the 42 days till expiration about 180 vol, and then today it's at about 100 and call it 30 vol-ish. So we've come down almost 50 vol points, and that makes sense. A lot of the volatility was built on the way up, and as prices are kind of pulling back, you get that vol crush. So selling that put has some sort of like built-in protection in it. If you change your mind and you want to take the position off, you sold vol at high levels, and as prices went against you, the vol went in your favor. So to me, that's a nice, interesting type of trade. It's very forgiving in the sense that if you change your mind, you could probably take it off. And if you really want to own the stock, then you get to buy the stock at a cheaper level, and sort of the return rate, like you mentioned, the July expiration paying you 10% at the money on the cash secured valuation. That's a pretty high rate of return if you're willing to take the stock. So either you get a great premium or you get to get the stock at a cheaper price. So to me, it's essentially a win-win.
Yeah, I love this strategy in IBIT. And in the event that, let's say you do take assignment of the shares, the options exercised, you want to sell a call against it, you can do that. Or if you'd like to, with really little impact to your margin requirement or your buying power, you can turn this into a strangle once you have the put on, if you get a little bit of that movement, if that's what you decide to do. A question everybody then has around the trade setup is always, okay, makes sense. What expiration are you focused on in terms of what you see with the term structure? And then how do you think about it on a per strike basis, whether that's in implied volatility terms, or what delta would you look at to possibly sell when you're actually going in there to set up the cash secured put?
Yep. When I trade cash secured puts, I usually stop looking at it as a pure vol type of trade, and I look at it more as a return on locked up cash, like the interest earned, so to speak, setup framework. So that's kind of how I look at it. Obviously, if you do further out of the money strikes, is going to have a lower sort of carry rate or interest rate earned on your cash secured put. And if you go to further expirations, that's also going to be true. It's going to be a lower interest rate. Now, the upside there is that if you get a sign on stock, it's going to be at a better price. So in my mind, it's a little bit of both. Typically what I do, I don't just sell one strike and one expiration. I kind of ladder into it. That minimizes my variance. So instead of being all in on one particular cash secured put, I diversify across a few strikes and a few expirations. But I'm not selling anything closer than October. So I'm looking at October, January of next year, and January of 2027. So those are kind of long dated things. I like that because it also makes my income generation a lot more predictable, as opposed to if I sell something very short dated, if fall comes completely down, I don't know I'll be able to sell something that good again.
And I suppose you have a lot of gamma risk on some of that shorter dated stuff too, versus kind of what you're describing here when you think about the theta decay. I mean, a pretty predictable cash flow. Obviously, the stock price can move around a little bit, but I really love how you frame that. And I don't think we talk about this as much on the show when you come at it from the perspective of selling volatility and you think about it as a business where I have a margin requirement. It's obviously not going to be, depending on what kind of account you have, let's say. But you have a margin account, you're not going to have to put up the full capital. Assuming you do want to take assignment of the stock, you need the money to be able to buy the stock with. But when you think about it in capital efficiency terms, and you compare that then against, let's say, investing that same amount of money in shorter dated treasuries or treasury bills here, you get obviously a much better return here. But for everybody that's following along, you come in here and here's how I would just mathematically size that up, right? We'll just randomly pick a strike. Let's go the 150. I want to sell this, and I can see that I've got, a $12,000 or almost $12,500 buying power requirement here. And I'm going to be taking in, we'll call it $2,400, $2,500 or so in premium. Decent return for, when you think about that risk effectively, if it were to go to zero, that's the investment. That's the capital required to generate that return. Great return for a 114-day period.
100%. Yeah. So that's like a 20% return in 114 days. You're almost looking at 60% annualized. And it gets even better because, you could use treasuries as a collateral. You could be in T-bills, or you also get interest on your cash that you receive up front as well in your brokerage. So there's extra juice to that yield. So to me, that becomes a very interesting type of trade to create a fixed stream of income, and then it's all in my trading account, so I can still trade in my trading account. So I have essentially a draw from these types of trades and structures, and I still get to trade my account for capital appreciation.
Greg, before I let you go, one last thing I want to ask you about Circle here, and appreciate you coming on the show today. A lot of people are obviously familiar with the risk that exists in terms of a stablecoin depegging from the value of the fiat currency. We saw that in, I think, 2023 regional bank crisis, momentary 10% depeg. I don't think you're going to see that as frequently, if at all, going forward with something like Circle. That's my personal opinion. But I'm curious, how do you think about the interest rate correlation here? When I look at the fundamentals of the business, it's driven by adoption, but it's a fantastic business in that, given the way the regulations are being structured, they can invest in treasuries and then can't share any of that income with the end user. So the company gets to keep it themselves. People have definitely seen how profitable Tether is, as an example. Do you think that's a risk to this in terms of how you analyze the business, right? Is it really just the interest rate risk here, where if in the event rates went to 50 bips, and I think that would be following some sort of emergency, as we've seen historically. But if that were to occur and you have lower rates, does that make you think any differently about Circle as a company or its valuation?
Yeah, absolutely. Interest rate risk is a big risk for Circle. To me, in context of our portfolio, this is the perfect risk parity trade. Risk parity is when equities go down, fixed income goes up. When fixed income goes up, equities go down. This is a direct inverse correlation between Circle and treasuries. I would structure trades like that. I would own fixed income bonds or fixed income future options or something like that as sort of the upside on rates going lower. And then on the other side of the equation, something like Circle on rates going down. That's a very kind of interesting structure. If I'm just isolating the analysis around Circle, I do think, yes, interest rate sensitivity is something that will affect the equity. But on the flip side, Circle has a lot of levers it hasn't started playing with yet in terms of, redemption or creation fees, for example. There could be something like that. Or wrapping USDC Circle into some sort of RWA convertible type of structure. That can be a fee as well. Or swapping the Circle to a different FX Circle, so we have Euro Circle versus USD Circle. That can be a fee there, which is cheaper than traditional FX swaps from banks. That can be done in small micro scales. So once the adoption sort of grows, and when we're betting on fiat, USD is the fiat I'd like to bet on. That makes the most sense. I think there's a lot of different levers to pull and push here.
Awesome. Well, Greg, we'll leave it there. This is on my watch list for sure. Probably going to put this trade on myself because I don't have a position in Circle yet. But as always, thank you for coming on the show, man. Appreciate your time. Before we let you go, though, for anybody that wants to sign up for the Amber Data weekly email, you got great thoughts, insights, and trade ideas in there. How do they do that?
Yeah, absolutely. So you can go to our Substack, which is located at amberDataDerivatives.substack.com. And here we share our weekly analysis on crypto vol and crypto-related vol equities as well.
Awesome. Well, Greg, thank you again. We will hopefully speak with you here soon, a couple of weeks or so. So tune in for that. We'll let everybody know when Greg's back on the show. But that's going to do it for the Tasty Crypto Show tonight. Victor Jones is up next with The Price of Truth. Until then, I'm Ryan. Peace.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80+ Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
If you missed the live show, here's our cherry on top weekly recap.
Hola!
Look at you guys looking like spy versus spy.
I'm in the UK. Vanetta, that got in. They let me in.
So how's the vibe in London? How's the weather? What's
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Oh,
yeah, it's Wednesday, June 25th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's Evening Show, a little podcast, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. My name is Victor Jones. Let's see if I can fix this. There we go. My name is Victor Jones, and we got a lot to talk about today. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on the Tasty Trade desktop or mobile applications. If you don't already have both, go get them. Do yourself a favor. Make your life easier. But if you want to be part of, am I going to do this right? Yes, this finger. If you want to be part of this little chat on your screen here, come on. There we go. If you want to be part of that little chat, there's only one place to do it, and that is on the evil Google YouTube. So head on over to Tasty Live's YouTube channel, subscribe to the channel, and your thoughts will be streamed in real time on this little live stream of ours. Shout out to everybody that's already in the chat. Who do we got in here? Ooh, you guys are rocking and rolling. Donna, how are you? Catan, great to see you. Lone, what's up? Theta Trader, Emmett, Brian Watson, the YouTube goat. Mark, how are you? Great to see you. As always, Cato, what's up? Oh, I just lost my spot. MP, John Stein, D-Chat, Gregor, how are you? So many more. Great to see all of you. Without further ado, let's get cracking here. 6147 on your screens, number one in your hearts. The S&P 500, everybody, a whole bunch of squadoosh. Ended flat on the day. The NASDAQ up about 1/5%. The Dow Jones down 1/4%, and the Russell down a little bit more than 1%, about 1 1/5%. Vol still somehow down. I suppose that makes sense because realized volatility was so low. It's about time, quite frankly, that implied vol catches up to realized vol. Realized vol was in the toilet, and we kept making that statement here. But implied vol was still juiced at like 22 or something like that coming into the week, and now it's catching up much, much closer to where realized vol is and has been. So even though we had a scratch day, when you don't move at all, implied vol should probably come in a bit, especially if you're in the 18s or in that range, 17s. So 1676, where we are now, /VX, still high at 19. If we take a look at the VIX term structure real quick, a little bit more slope. That was looking a little bit more flat for the last couple of days. It's now got a bit of slope, but between 19 and 22 out from now until February, that's still a decent amount of, I want to call it nervousness, trepidation, uncertainty, I suppose, out into the next, half a year, something like this. So even though all's well in sort of equity pricing world, la la land, we shall call it, vol just continues to signal that the market is concerned, as well probably you should be, right? You could get anything coming out of the Middle East. You can get anything coming out of the White House or Mar-a-Lago. You can get anything coming out of these trade negotiations. So I suppose moving higher in terms of equity prices while also keeping vol bid, while also keeping gold bid, I suppose some of that makes sense in a recipe together in the short run. Let's get a little of this glow, if I can. But it seems like, man, if you're a vol seller and you stayed mechanical, the market is paid in spades. This week, for the last couple of days, those that are taking directional bets, it's a bit of a mixed bag. If I'm being honest, a bit of a mixed bag this week. We'll get into that in just a bit. In terms of bonds, I'm kind of loving it. Not much action here. A little bit of a gentle float higher. in yesterday's session. A decent range here today in terms of one full point, a high of 115, closing somewhere in the middle, 114 and 18 ticks. I'm okay with this. I'm okay moving up slowly, even though my gammas or my position is sort of positive gamma. You know, if we slowly make a climb to 117, at least if we get there, I'll take it. A win is a win. I'll take it. Would I love a little bit more speed here in the upside? Yes. But a win is a win. I will take it. Japanese barbecue sauce. Good God. That's how you know vol's low. When everybody coming in here and you're screaming at each other and you're like, stocks are going up, stocks are going down, vol's too high, vol's too low, bonds should be 10 points higher, 10 points lower. That's when you know the markets are rocking. You know how you know you've got 11% at the money vol? When people come in here talking about barbecue sauce recipes. I'm telling you. I tried to tell you guys long ago that it's painful trade through 40 or 60 VIX, but it's way better to go through those periods where the market is scaring the shit out of the children and coming in here talking about barbecue recipes with 11% at the money volatility. I'll take it any day of the week. I cannot stand summer doldrums where we come in here and just try to pretend like things are rocking and rolling. You know, I don't like doing that. In fairness, though, I only have a 90-minute podcast. If I was like running a 24/7 news network and I had to somehow pretend that there was always stuff to talk about, and now there are things to talk about, right? If I go way off the beaten path, the New York City mayoral election, we could just stick to the Middle East conflicts and its potential impacts on crude oil. There's so much in that to unpack. You could still talk about our debt, which we seem to not. It's somehow moved from front page news to somewhere near the opinion section in the back of the newspaper. Everyone's forgotten about that. And I don't know what it'll take to move that back up to the front page. Maybe a failed auction at this point. But at this point, it seems like the market has sort of absorbed that. Yes, we're fiscally irresponsible. Next headline, please. But at 114.20, I'm okay with this. 114 seemed to be this point of control, plus or minus 3 points, and I'm down with us going back and finding the previous sort of point of control or line in the sand, which was 117. Drift 3 points higher. I'm totally down. In the front end of the curve, I don't have a meaningful position on anymore, but my thought process is that once we got to around 39 basis points or about one cut price for the next year, I thought that was too low. I thought the market would eventually work its way back. The market would put more cuts in. Whether or not we see those cuts in reality, whether or not Jerome Powell's going to play like a total badass on his way out of the door and then all of a sudden try to pretend to fight inflation. The arsonist becomes the firefighter, as they say. That is possible, but it seems like the market is getting a bit more dovish. I have this weird feeling that when the Fed starts saying we have no idea, what they're effectively saying, and I'm just making this up, so don't follow me on this. This is like, what they're effectively saying is markets guide us. It means every 3 months we'll come in here with an SEP that's going to tell you what effectively the bond market is telling us. When they have an opinion and they wear that opinion, God help us. But when they come in, they say, we don't know, 2 meetings in a row. I think when that kind of indicates is they're going to listen to the bond market. But there's some part of me that says, all right, if that was true, then why'd they pull a cut? Because I don't think that's necessarily what the bond market was telling them, at least in the short end. But maybe that's telling them in the long end. If you don't start protecting purchasing power, we're going to light this thing on fire, and you're going to have to refinance government debts at 5% plus. So, we're in a big game of liar's poker, and the game here is figuring out who's lying, because everyone's lying. The game is to figuring out who's lying and to what extent. At least that's how I think the game is being played. I think there are a lot of people that come in and they read the headlines and then they try to interpret how to play those headlines. And I think everything's a big damn lie. And the game here is to figure out who's lying and to what extent, and then how to play those lies. Perhaps the better question now that we've had movement in the short end of the curve, is whether or not, how do you play it from here? So we've got one more meeting in July that the market does not feel like we're going to have a cut. This is sort of these aggregated meeting probabilities mean 75% we stay where we are. So this column is where we are now. 75% we stay where we are. 25% probability we drop by 25 basis points. So the blue, the highlighted blue for each one of these meetings, your meetings are on the left, is effectively where you would expect the Fed funds rate to be at the end of that meeting. So you can tell July, the market expects on a 3 and 4 chance that we stay where we are at 4.25 to 5 to 450. In the September meeting, they've got about a 90% chance, rounding up a bit, that we do drop 25 basis points, and we're at 4 to 4.25. At the very next meeting in October, the market has priced about a 75% chance from there that we drop another 25 basis points, and we're at 375 to 4. In the December meeting, it's a coin flip. Right now, it's about a 50-50 probability that we stay, but it is possible that we have a third cut in December. So that's sort of the way to read this. I won't go on to 2026. I suppose I will. If we go on to 2026, you've got a high probability of a cut in January, high probability of a cut in April, high probability of a cut in July. So 3 priced in 2025, 3 priced in 2026. That's nothing anywhere close to what the Fed just put in front of everybody. But as we all know, the bond market price is what it wants, not what it's told. And so at some point, what's interesting about these moments, in my personal opinion, I love these moments. I love the moment when the bond market gets too far away from where the Fed is, because that at some point, one of those things has to be wrong, or both of them have to be wrong. So at one point, either the Fed needs to capitulate to where the bond market is, the bond market's got to capitulate to where the Fed is, or both have to come meet at some happy medium. But in either case, that means movement. When there gets to be a decent spread between what the Fed just told you, and it's not like they told you in March, they just put an SEP in front of you a few days ago. And so when that spread gets wide, I personally like those instances, because we are all playing a game of liar's poker. So either the Fed's lying or they're playing this big game of Mr. Magoo. Either the bond market is getting too giddy about pricing what they always want, which is this heroin addiction, this heroin trip of cheap money, or both are just smoking crack, and both need to come to a meeting of the minds and meet somewhere in the middle. And I think we're slowly getting to a place where there's putting some distance. We're putting some distance between the two, and I like that, because that means movement. And I'll go back and I'll show you the SEP. I talked about this at length a little bit yesterday with our good friend Ilya Spivak. But what the Fed is effectively saying is 3.6 by the end of 2026, and the Fed Fund futures market is putting us somewhere at 3 to 3.25 by the end of 2026. So you can see there's a healthy spread being built in between what you just literally saw in the SEP. Hey, we're not going anywhere below 3.6. And the market's saying, yeah, you are. Go F yourself. The market's saying GFY. And again, I'll show you. Same thing for 2025. 2025, the market is saying you're going to be between 375 and 4. No. The market's saying you're possibly going to be between anywhere. The spread is 350 to 4, let's say. It's a bigger spread. So 350 to 4, 375 middle. That's kind of close to where they are. It's one cut more than the Fed is saying. Fed saying they'll be at 3.9, maybe one cut more. But you can see market's getting much more aggressive in 2026. I like this. That means we get to take some bets here. Who's right and who's wrong? We'll see a little bit of movement, likely in the 2-year. And so I think we keep playing this 2-year. I think we keep playing this 2-year. It's funny, you know, the administration is screaming at the top of its lungs. They are screaming for a cut. But you know what? If you wanted to cut, man, it seems like the path is clear. If I was part of the administration, the path here is, on one hand, I want to continue these trade negotiations. And for whatever reason, I kind of understand it, but for whatever reason, the administration wants what they've called strategic uncertainty. Okay, here's what strategic uncertainty means. I can't tell you what my goals are, because if I tell you what my ultimate goals are, I give the competing player, I give them an opportunity to play around my goals. And I don't want them to know what my goals are or to be able to play in a way that block my goals. So they don't want to tell their opponents, or their counterparties, I should say, in negotiations what their goals are, which means they can't tell you, the public or the media, what their ultimate goals are. So everyone's sort of locked in this. You got to kind of guess what the goals or the outcomes are. And so that means they can't tell the Fed. And the Fed's saying, well, if I don't have a goal here, if I don't have an understanding of what the end game is with tariffs, then it's hard for me to plan monetary policy around that. So we're stuck in this weird little game of chicken. We're stuck in this weird little game of chicken. And I don't know how long it takes to get out of this game of chicken. Likely you've got to get as many of your deals done as possible. But I also think what could also be happening, I said a lot of alsos, I think the Fed could just be using this as an excuse. They have an opportunity here to just hang it all on tariffs and the uncertainty that it created. And so they can finally do their job without being blamed for the outcome. You know, I was under the impression that the reason we have an independent central bank is so that they could do what the politicians would not. But it seems like it's just as political of an entity as both sides of the aisle, at least from where I'm sitting. And I don't mean political in that the Fed wants one side to win or to lose, to do better or worse. I don't know. Some people have made that charge. I'm not going to go that far. All I think is like they're operating politically instead of just in the two mandates, which is, maintain stable prices and maximum employment, whatever maximum employment is. And it seems like we're doing a whole lot of other things. A whole lot of other things right now. I did read today. Let me pull this up on your screen. One of the most interesting things I read today was like, I'm going to give you here's the no duh moment brought to you by Sunkist. I loved those Sunkist commercials. Here's the no duh moment. This sort of tickled me a bit. Schmidt suggests replacing core inflation with a measure that includes food. I'm going to read this again to you. So if you understand, there's an inflation measure, okay? Then there's a core inflation measure, which strips out food and energy. Why do they strip out food and energy? Well, they say it's because it's volatile, and you wouldn't want a central bank making too many changes in monetary policy based on these volatile measures. Though to you, it matters because most people spend most of their money on food and energy. But what I think is hilarious here is suggesting the idea that we should come up with a new core inflation with a measure that includes food and basically only strip out energy. This was your no duh moment of the day, brought to you by Sunkist, our fake sponsor. You know, if there's any funny writers out there, I would love to do a fake sponsorship every episode. and do a fake podcast read for a fake product. I don't think I'm clever enough to come up with that. I've tried to do this a few times, but we never had sort of a listener that was clever enough to come up with like really funny podcast reads. And I'd love to do that. But to keep cruising here, I think bonds are going to continue at least for a little bit of time. Long end of the bond curve will be boring. I could totally see it moving higher. I'm continuing to stay long deltas in the long end of the curve. I know there's a bunch of reasons not to. But I think the sentiment on bonds right now is so washed out that I don't mind stepping in. I might be picking up pennies in front of a steamroller. I don't know, but I don't mind that risk. And I've done it in a super risk-defined way. I'm just effectively betting on 117. Though I do think ZT, I think this one's going to be where it's going to be more interesting in the front end of the curve. Just because that spread between what the market is currently pricing and what the Fed is saying, I think that spread is growing. I think it will grow. And then at some point, somebody's got to tell the truth. And that when that happens, that's good vol for us as traders. I've said that before. I will leave it there. Last time I'll say it. Let's take a quick look at the 210 spread. This thing is like everything with the bond market right now. It's like not going anywhere for a while. Grab a Snickers. The 10-year Treasury, or the distance between the 10 and the 2 is about 55 basis points. It was up to about 67 basis points. We flattened out to about 45. We found now a healthy medium somewhere in the middle at 55 basis points. And I don't think there's a bunch of edge to betting either direction right now. You're right in the middle of its range. I think if we steepen out, which I think if I had to pick which one of the directions we go right now, maybe I give it a 1 to 2% edge to steepening. Maybe. But I would say it's, I kind of like the push more than I like the anyways. So 55 basis points, where we at? I don't think there's edge, so there's no trade there. Let's keep cruising. Let's see what you guys are saying for a second. I'll go on to the next topic. Victor, break glass and use Taylor rule. The ham is making the call from inside the house. Oh, you guys are talking dinner, everything else. Spam is like gold. You're crazy, Catan. What are you, Asian? I should have read the name. There's no, but my wife, like, I didn't eat that stuff as a kid. No offense to anyone who did, but I could just, that's just Impossible meat. It's the first version. Impossible beef 2.0. It's just a fancier rebranded Spam, is it not? But my wife is so into that stuff. I thought was wild. Donoski says you could probably retire off 10 shares of Apple if you bought way back when Apple was that cheap. That's this game that marketers play. It's the hindsight bias. So you'll see a bunch of these ads in like Instagram and things of this nature. Well, they'll put a chart of how if you would have invested $10,000 in this instrument in 1982, right? And they pick the bottom and how much you would have now. It's all this thing of like predicated on hindsight bias. It's like, yeah, okay. Which is the one I should put my money into now to do the same thing going forward? You don't know. Okay, then what does this message do for me? I always hated that. That's how I knew when I'm like looking around and I'm just evaluating like the brokerage landscape. If I see that, I'll go, okay, this marketing department or this brokerage firm has no idea what this game is actually about. Or they do, and they just don't care that they're using this cognitive bias to try to build this mousetrap to capture new accounts. You know, there's certain places will just go for anybody with they call it a pulse and a purse. If you're alive and you got money, we're going for you. And they don't really care about the integrity of the game. So if you see that, I don't know, you can do whatever you want. But whenever I see that stuff, I'm like, either this brokerage firm has no integrity or they have no know-how into what this game is all about. It's a gigantic red flag. The problem is you don't realize it's a red flag until after you're no longer a first-time trader. You know, that's what they always get you with this line. Whether you're experienced or a first-time trader, it's like that's another red flag that you're just throwing out of wide-ass net for anybody with a pulse and a purse. I hate that line. Whether you're experienced or a first-time trader. How about you pick? How about you pick which one you're talking to right now? Why hasn't RFK banned spam yet? I don't think that's our problem. I don't think people are lining up to buy barrels full of spam in the U.S. You know what I mean? I think we are shoveling red dye 40 Skittles and taffy into our mouths and sucking back 10%. I think the number I saw, 10% of food stamps, or it's not food stamps anymore. What's it called? Gosh, I'm forgetting the acronym. SNAP. 10% of the SNAP money goes to soda. So in a weird way, you could look at that budget, right? You look at that annual budget, you cut out 10%, and you go, this is the subsidy to Coke and Pepsi that the American taxpayer is paying. And then if you take it further, you go, okay, well, what are the downstream impacts of paying N amount and billions of dollars in soda subsidies? You can go down the line to the health impacts, the health costs, diabetes, and these other types of things. So I would imagine if you're going to ban something, you ban something with you're not just banning the thing, you're preventing sort of additional cost for the taxpayer in the back end. Because at the end of the day, let's not pretend this is about, it is about health, but it's about cost. We're drowning in debt. We can't afford to be sick. That's the truth that nobody wants to say. It's like, yeah, we don't want to be sick, but we can't afford to be sick. I think in a way it's the same thing with some of these prison systems. Oh man, why do you do this to yourself? In a way, I think the reason you defund police and the reason you increase your felony theft from $500 to $1,000, as a lot of cities across America has done, is you can't afford. You have a system that's broken, and you have a lot of people that will resort to desperate measures in desperate times, and you can't afford to throw them all in jail. So yeah, the defund movement sounds great. It sounds like it's a humanitarian thing, and I don't know. I'm a cynical guy. I think it all comes down to cost. I think trying to make Americans healthy sounds great, but I think it all comes down to cost. I think we can't afford to be sick. We can't afford to take off sick days and pay for sick days. We can't afford to be paying people's health care expenses anymore. I think it all sounds great, man. All this stuff gets wrapped in pretty bows. The pretext for going to war, it gets wrapped in these pretty little bows. And like, we're the good guys going out to save the rest of the world, man. But like, I don't know. I stopped reading. I stopped believing. The hero's journey is nice, right? But it really only applies to fiction. Reality rarely follows the hero's journey. And I think reality rarely has a single protagonist and a single antagonist. I don't know, but we read a lot of comic books and we watch a lot of movies, so our politicians can feed us this hero's journey's nonsense and we'll eat it up. I'm sorry, I don't know where that came from. Somehow that was my take on spam. Did someone say NVIDIA new all-time high? Yeah, NVIDIA and Palantir had great days. Oh, I didn't see Palantir backed off the high. We did make a new high. haven't backed off. I'm telling you, you guys, some of you guys should be way more nervous about. I bought Nvidia at like $8 2 years ago. Some of you guys should be really nervous about what the world looks like with Palantir at $150. I'm not saying it's bad necessarily for all the people. I'm not saying there are some conveniences or positives that come with this. I don't know. Am I the only? I know I'm not the only one who's skeptical. But you know, it's like everyone loved to cheerlead Facebook higher and higher and higher. Then you realize, like, oh my God, this is a direct main line into the hearts and minds of the people. And with this, you can flood, you can microdose these people with thousands of messages, impressions every single day. And those impressions could just be, you know, buy a bottle of Coke. You'll feel better. You'll feel more refreshed. Those messages could be, and started off as, you know, buy this pillow. It's more, you'll get more comfortable sleep. And I think over time, people sort of recognize that, hey, this app radicalized my grandmother. She's a political zealot all of a sudden, and she wasn't until you made this app, and she just got on it to figure out when everybody's birthdays were. And now she's like, now she's signing up to blow up Teslas. Like, what happened? I'm telling you, it's how it starts, with convenience. It always starts with features and convenience. This is how I sort of think about AI. I don't know. People, you might be down with what I'm saying, might not. That's what I think about AI. I think all this stuff is going to start out really powerful. You're going to get really powerful aspects of these features. I think they're going to be super cheap. And at some level, you'll get consolidation. You'll get winners which will emerge in this LLM game. I think the power then starts to get tiered out. So then there'll be a free version of AI, which will just be, you know, straight propaganda, one way, not, you know, then there's maybe a premium version, which will give you more nuance, more research. And then there's sort of like this professional version, which will probably be more likely to what it is like now. I sort of think I see that world in the future where today I think everyone gets a lot of benefit from this stuff. And then over time, it becomes like this cesspool like Facebook. It's not even worth getting on anymore, you know, but it becomes too entrenched, like sort of like YouTube. You know, you try to watch YouTube without the premium or the red version, you're watching ads every 10 seconds. That's how I see AI evolving, I think. But you can't put up those paywalls today, those really meaty paywalls, because you actually need to train the model. So they got to keep you asking questions, so they can't put up a pricing structure that will create too much friction to keep you out of these apps. So they put up just enough so that the value outweighs the price. In some cases, it's free. And they get to train these models until the point that they don't need your silly questions anymore. They don't need your silly questions. And that's when the paywalls go up. And if you want access to the real knowledge, you're going to have to pay. It's coming. You like that? D-chat like the radical grandmother line. Radical apps are the new hippies. Palantir looks like $1 million multi-generational investment, please. I'm not saying it's not. I'm just saying, what good does it do to have a generational wealth investment if you are locked in your home for the rest of your life? What good does it do if you're now living in a police state? AI will take out all back office functions. They have no choice. Let me ask you guys this question. Tom Banjo made that point. I'm curious. So there's this line that people will say, the optimists will say, And I do think over time, you get paid for being an optimist. Very few times in history do you get paid for being a pessimist. Though I'd argue over the last 4 or 5 years, betting on the erosion of the standard of living of just generally people across the world, it was a good bet, and it's still paying off. But generally, I think being an optimist pays. And there's this, I would say, this nervousness about AI. About what that will mean for people, the general employment of the people, the general purpose and productivity of the people. And the optimist will say, this is going to create more jobs. I wouldn't want to say the pessimist. Some part of me wants to call him a realist, or but the group on the other side will say this is clearly going to have an impact. And that less people are going to be needed to do more things. And I am genuinely curious. We got, a decent number of people. We got a decent number of people here, and I'm curious how many of you believe that when all is said and done, let's call it 10 years into the future, that we have a higher labor force participation rate than we do today? How many of you feel that we're going to put more people to work in the next 10 years versus less? How many of you have the glass half full perception of the impact to AI on the workforce in the next 10 years? I'm very, very curious. Because when I have these conversations with Tom, and to his credit, I think he's a lot of the contrarians I've met just generally they're just cynical people. They're not really contrarians, they're just cynical. I think Tom is an ultimate optimist and a contrarian at the same time. And I know that because his views very rarely always align that way. They're always optimistic on a long enough time frame, but they always run short-term counter to what people believe, but usually for a different reason, not because of any cynicism. It's because of generally ways of thinking that people haven't thought of, or at least I hadn't. But on this particular issue, I find it really hard to get in the camp where AI is somehow going to create more jobs. It's somehow going to create more jobs in the next 10 years. I hold two thoughts at the same time. One, I do not think we're as close to generative AI as people say. I have no real reason. It's not like I'm deeply read or deeply studied in the subject matter. From the people that I read, and I read a diverse set of minds in this space, I would bet that we're not as close to AGI as sort of people think. But I feel like over the next 10 years, the goal here, the very clear goal, is I think we will have a higher rate of unemployment, higher natural rate of unemployment. I think people will drop out of the labor force, or they will drop down in the labor force. I think very few, smaller amount of people will move up, so their value will increase. I think more people's value will decrease in the labor pool. And I think margins actually go up. Because you get more productivity on less cost. So I think generally, as a generalization, I think margins go up. So I think while people are going to be in this mode where they go, oh my God, unemployment's going up, here comes the recession, I think they're going to misread everything. I think, yes, you are going to get unemployment going up, but margins are going to expand because of that. And the government is the one who's going to get stuck holding the bag, trying to pay these higher costs. And so we're in this weird position where corporations are in a great spot. Governments are in a horrible spot. And I think ultimately some portion of workers, some majority of workers end up suffering. They get less labor leverage in the marketplace. Some their skills won't be needed anymore. And so that's the way I see things happening. But I don't know if I'm overly pessimistic on this. Tom Banjo says agreed. Mark says, I'm actually an AI bot. I died years ago from bad stock trades. I remember this is maybe a decade ago. Maybe it's decade to 15 years, somewhere in that ballpark. I remember reading an article, and the article was about one day, because we had all these disparate technologies, right? At the time, we had emerging proliferation of social media. We had some aspects of automation, and then like Siri and those types of things were in their very, very early iterations of beta and release, those types of things. And I remember reading something close to 15 years ago, and the idea is we're going to be able to connect these technologies together. And there is going to be an ability for when our generation, the millennials, pass away, the next generation will be able to sort of keep us alive, because we would have contributed so many of our thoughts on Twitter or Facebook or all these social media platforms. And we will have, in the near future, artificial intelligence coupled with sort of this ability. We have so many pictures that we would have contributed. We'll have an ability to sort of to guesstimate what you'll look like. So the article was about how we'll eventually be able to couple automated audio, video, AI, and all of our social media sort of contributions, and couple that into sort of this living digital being even after we're gone. I thought, how wild. And I thought the probability of that was high, but I was curious how long it would take. And here we are, like 15 years later, and the automated video, the AI videos have gotten so good. The audio's gotten so good. Its ability to mimic has gotten so good. So we're effectively there. We are effectively there that we can keep anyone digitally alive as long as possible. And I don't know that a lot of us have processed it. Like, there's a part of me that goes, my son and my daughter are going to be able to talk to some AI version of myself. And I don't know if I'm happy about that, or if I should be very concerned that there's no way that that thing could be saying what I would be saying. You know? And if it is saying what I'm saying, that's almost even more depressing, that I can be predicted to that extent. Let's see what you guys are saying on this AI thing. Increased. Hold on, let's see. Oh, you guys are way on the other side. Less by a lot. Tom Banjo says half empty. I believe it's less, but I don't think it's because of AI, says Lone. Interesting. Expand on that, Lone. Someone has to oil the robot. Labor PR will keep dropping. I think so too, Brian. Lower, but I think that's good. People will have more free time to do things they actually want to do. Absolute beginner, I totally disagree. Okay, so what has to happen, Absolute, in order for this has always been, what should have happened when we shipped all the manufacturing jobs out of the country, that was the sell. The sell was we would all move up the value chain. The problem, though, is that our education system does not create a bunch of people that come out of school with the ability to move up the value chain. So my issue with this argument is it's theoretically possible, but you need a system designed to create that outcome. And we have not created that system. And it doesn't seem like we're anywhere close to creating that system. So a bunch of people with more time, but no productive use of that time, is, what's that saying? Idle minds turns to idle hands, or something of this nature. I don't think a bunch of idle time is great, and I don't know that we have an education system or just simply social culture that's going to move people up the value chain. I don't think that's the case today. I haven't lost hope that that's possible, but we need to get moving if that's what we want the desired outcome to be. Otherwise, I think we end up with more crime, more social unrest, more bad policy at the end of the day to try to pacify sort of a continued populist movement, which will just beget worse and worse results. So yeah, I mean, I do think that's possible. I do think more time to know how to use that time. I think there are a few people, absolute beginner, that's going to be helpful to. I think you were likely one of them. Giving yourself the ability to be twice as productive with half the time will likely only create more productive output. But can you say that about 350 million people? A robot, a worker, and a dog to watch the worker. Successful robo-taxis will take away a lot of rideshare workers. Trev, you have no idea. I've been trying to put together the numbers. Just Amazon drivers alone, and this is just direct, not even the indirect exposure. But Amazon said they're going to be working on humanoid robot deliveries. That's 275,000 jobs, just that alone. And now let's expand that to all delivery services, all driver services. I've been trying to put it together, both the direct and indirect. It's a gigantic number. Donna Ski with a little bit of optimism here. I think we need that sprinkled into this gumbo. I think we'll employ more people in the future, but the nature of jobs will change. Donna, God bless you, my friend. I hope you're right. And it is the optimist ultimately that owns tomorrow, I believe. So everyone give a round of applause to Donna for giving us a little optimism here. I'll do a few more of these and then we'll move on to the next one. BLS has elder care, the top 5 jobs in 5 years or less. Interesting. NX says higher unemployment with even more people working less hours. I think so too. I think that's the end result. A bunch of part-time workers, a bunch of full-time workers that drop into multiple part-time workers. All right, we had fun with that one. You guys, that one got you guys focused. Tax robots at 200%. Night moves, I thought about this too. I thought about this, and I think that's ultimately it's going to be a debate in the future for sure. The problem with this night moves is it's really hard to do without making your economy less competitive. So if you're going to tax robots at 200%, but Saudi Arabia is not, guess where they build the factories and the robots? So it's just that's the most interesting thing that I always come to, that you sort of are allowed in a sort of quotations, you're allowed to affect change in one legal jurisdiction. But the problem is you're competing for capital. You're competing to prevent capital flight, not only on how good of a consumer you are, right? If you're a great consumer, you're good at labor, then money flows here. But if you want to tax, money flows elsewhere. You'll get some goods, but you lose jobs and you lose capital tax base. And so there's like the concept of unions is you want to, or just general like politics is you want to get a big voting block together. But when your voting block, even if you get past the divisions, which we can't seem to do here in America, we subdivide ourselves into units that are politically meaningless. They have no power. But let's imagine you could. Your power would be limited by the jurisdiction, but capital goes to where it's treated best, which means its capital is making jurisdictions compete against each other for the capital, whereas you are competing for laws only within your jurisdiction. And I think that's the limitation. We don't really talk about that. So to your point about like taxing robots at 200%, the only way that works is if you somehow get a global a global tax, which means you can't have capital flight. Now, the problem with this is you're now talking about a global governance, which you probably don't want either. You're damned if you do, damned if you don't. That's the little game theory game you got going on, politics. How do you solve for that one? Theta traders. We're at the point where people are dumping in lyrics into the chat and seeing if I'll read them. Seeing if I'll catch on. And either I'll read them or not. Soon you guys are going to be putting fake names, those Bart Simpson fake names in here and seeing if I'll read them. Bitcoin back at 107. They gave you a little discount, man. Sub 100,000. How many of you took it? I'm curious. 107, 100. In fairness, though, we are making lower lows and lower highs. I don't know how much of that I'd read into, but we are in a little bit of a downward consolidation phase. I guess somebody might call that like a flag or something like that. I don't. Me personally, I don't do much of the technical analysis patterns and stuff and Japanese candlesticks. Don't get me wrong. I know them like the back of my hand. That was my whole thing at one point in time. I effectively just programmed. I programmed technical indicators for people or pattern recognition for people. So not only do I know those patterns, but I kind of had to devise math around them. So I know this stuff, but I never found that they helped the people that I was building these indicators for. I never found that there was a meaningful edge in them for others or myself. And when I just started thinking about this as a poker game, me personally, I had more success. When I started playing it like poker and reading more game theory and trading from that perspective versus like some magical crossover, I had better success. I think I'm wired for that. Depends on how you're wired, man. Victor, can AI save us from ourselves? No. That answer's no. I don't think so. And, all right. Damn it. I'm putting this on you. Who asked that question? I kind of like that question. I've got a big beef. As many of you know, I have a big beef with that big, stupid, ugly bill. The big, beautiful bill, as it's known. I have a big beef with it. I think it's one big, beautiful broken campaign promise. And one of the things that I didn't catch on to in my first read was this idea that for the next 10 years, federal law will supersede the states' rights and their ability to regulate AI. And I think some part of me, as much as I'm upset about the lack of fiscal discipline that's built in this bill, much as I'm upset about it trying to raise the debt limit $4 trillion, even though I think the debt limit itself is sort of a funny, stupid thing, it at least gives the leverage to the minority party to come back in and have conversations. So I do see it as partially useful to the minority to keep us somewhat centered so we don't go crazy on one direction or the other. But the idea that you can slap something in this bill that says states are unable to regulate AI for the next 10 years is insane. It's insane. And I cannot believe there's anybody that's down with this concept. First of all, let's imagine, okay, let's play this out. If you're the Republican Party, right, if you're for free markets and all this other shit, if you're a state that regulates AI, whatever benefits there are from AI job creation, you're going to lose that benefit, right? You know, if Illinois decides to crack down on AI regulation, well, what that means likely is they lose a lot of the job creation in Illinois from AI companies, which means a brain drain somewhere else, which means the free markets will say wherever you have less regulation, you're going to get more job creation. And those states would be successful or more successful, and those that choose to highly regulate it will be less successful. Theoretically, that this is the way it could play itself out. And perhaps that the state that chooses to regulate, they're okay with that, but they want to protect either the consumer or some sort of social fabric, and they're okay with the trade-off that they're making because their constituents want that. The other possibility is that that regulation creates a better social order than maybe a place with no regulation, and that creates the demand for that same type of regulation. That's possible, less likely, but possible. I think the idea that we have no idea where AI is going over the next 10 years, that we have no safeguards really in place right now, and that the only limiting factors right now is capital and materials. Those are the only limiting factors right now. And that we want to put something in a bill that says we cannot regulate something over the next 10 years that's moving at the speed of light that we don't fully understand, and that we don't know what state it will be in 2, 5, 7, 10 years. This is insane to me. It's absolutely insane. And it's the greatest example of a handful of people with market access and capital creating this barrier around their business. Imagine a government that it's creating a law that says there can be no laws. Think about that. Think about what the purpose of a government is. And the government itself, a government who theoretically is down for deregulating things, is creating a law that says thou shalt have no laws. To me, this is insane. And I don't know if I'm crazy, if I'm just seeing this through the wrong lens, if somebody can explain this to me. But why you would want to take away a state's right to regulate is insane. Am I in left field here? Grumpy Mike says, if you guys don't stop dumping Whitney Houston lyrics in the chat. Gregor says the big beautiful billionaires bill. Yeah, bro, like I don't understand. There's a bunch of people. I was talking about this with Chris the other day in a different context. And I know I talk about cognitive bias a lot, but I think I see it everywhere. There's a sunk cost fallacy to when people make a vote. So when you vote for somebody, you are not obligated to agree or to justify 100% of things that elected politician does or says or enacts. You do not have to do that. Even though there will be people who may have voted for the other person, and they will do the same. They will do a different cognitive bias. They will do counterfactuals for 4 years. They'll say, "Oh, this is what you voted for," or "If you would have voted for this other person, it would be so different." They'll do counterfactual arguments, which is just a bad debate tactic to begin with. So they're out in left field. But then there's the people that suffer from sunk cost fallacy, which they believe that because I put so much effort into this that now I have to fully justify it. I have to keep riding with this. And you don't, man. You don't. No, all political representatives are generally a coalition of people who do not agree on everything. And what's hard about a coalition that somehow has billionaires and a working class is that their desires are going to come into conflict with each other. And you're a bozo if you think that if you're part of one or the other class and you're siding with stuff that doesn't benefit you, it benefits somebody else, and you're siding with that stuff, you don't have to do that. You don't have to get yourself in a world of sunk cost fallacy. And I think this bill is one of those things. It's just like I'll talk to people. It's just like, oh, trust Donald Trump. Trust. Like, what do you mean? No, I trust my own ability, my own reasoning, my own logic, I sat down and read this big stupid thing and these big stupid ideas and this big stupid grift. And it's a bad idea. There's a couple of decent things in there, but this is just generally a bad idea. Lawrence Markle, Peter Thiel, and the Silicon Valley VC bros own JD Vance. Yeah. There's a... I don't know, man. Sometimes you want to believe that where a person comes from matters, If you come from a small town in Ohio and you grow up with this shared experiences of other people, that no matter how high you ascend in life, that there's something inside of you that knows where you come from, that knows the plight of those people. And how can you let power allow you to betray your own family or the people you grew up with? Who can do that? I guess only the people that seek power have the ability to do that, I suppose. Donoski says, I had no idea there was a provision preventing states from regulating AI in the budget bill. Yeah, they don't talk about that, huh? Funny how that never shows up on Fox News or CNN. Why is that? You guys are getting gritty in here. Yeah. Cass saying it's a sitcom at the end of the day, politics and the NFL. 100%, man. That's the funny thing. Seeing it for what it is, like this giant elaborate production. But then you look like a crazy person. You look like the crazy person. And you tell everybody the nightly news is it's a soap opera. And some of those people know it's a soap opera. They're participating in one. And some of those people are just so brainwashed that they think they're purporting the news, actually. Crude oil, 65.25. Seems like we're done. Seems like this move is over with to the downside. Maybe a little bit of consolidation here around 64. And maybe it's time to take a stab. Time to take a stab at all. If you've got some, let me not say that. Not tell you what you should do. For me, the things on my energy list, I think I'm taking a stab now. I think it's probably the crude oil move seems to have exhausted itself. I could be wrong, but it seems to have exhausted itself down here around 64. A lot of these energy stocks have taken a little bit of a discount here. I like energy, famous last words, and I think it might be time to take a little bit of a stab. What was the one? UHC. That's it. UHG. Nice try. There we go. All these healthcare stocks left for dead. They got to get growth to come down. Growth comes down, then maybe we get a bid to these bad boys. NX saying sometimes they get too far removed and they no longer associate with it anymore. I see it in my work when people go from the front of the line to the corporate level. They forgot the ones on the front line. Damn, man, you just opened up a can. I don't know if I'm able to talk about this, though, without getting a little bit emotional. So I see this in my world, too. So I see this in my world a lot. There's a lot of people that get into financial education because they want to help people, because they somehow figured out how to acquire wealth, and they see either the mindset or the methods that can be used, and so they go, okay, I want to start this financial education thing. So people will create these platforms, and they'll give these inspiring messages and whatever. And then one of two things happens. Either they are successful and they transform completely. Their message completely transformed. The platform transforms. It loses whatever like character and integrity or sort of mission statement that the platform has at its beginning, because ultimately there's no test of a person's character. Like, I think people have gone through trials and tribulations. I think those are a test of character, but they are learning experiences more than anything else. And as long as you learn to overcome adversity, it's a lesson that, like, you don't learn it more than once. As long as you learn to overcome a failure, to learn from failure, then it puts you on a path of sort of this growth loop that Ray Dalio sort of explains, of failure, learning from failure, creating a new system, trying again, and growing, running into a new failure, so on and so forth. Sort of this path of growth and knowledge is just this process, this loop of failure, learning, designing new systems, trying again. So, but I think once you learn that, it's just the thing you keep doing. But the true test of character is when, like, you run into success, when you're given the things that you've most wanted, and you can never have. When the limits of your own consumption or gluttony or all those things are completely removed, and now you're left to your own devices. That's a true test of character. There's no limiting factor on who you are as an individual. You can donate to people. You can use your time to make communities better, to make people better, or to give them more knowledge. You can, there's no limiting factor, or you can just totally, pig out on all of your desires. And so what's interesting about, the last 5 years to watch a bunch of this stuff happen is I've seen some people that have found success. They've stayed true to whatever their mission statement is. More people that find success, and you see what it does. You start driving fancy cars, wearing fancy clothes, going to fancy places, being seen with fancy people. And you can sort of tell, like, what that person had always secretly valued, but they use this other message to reach a populist audience. And then there's the people that maybe don't find success, and then they find something to blame it on. But I see that all the time. Like, you come from a place, you find success, and there's your true test of character. And I'm not going to act like, I've personally been put in those tests. I think, I don't know, I'd like to think I'm 50-50. But I've failed as many of those tests as I've passed. But I'd like to think I'm passing the important ones. All right, let's keep going. Let me guess, XHB, Emmett says. No, I'm not going to go there. I did put it up on the screen. Just a quick heat check, that's all. I always hope I'm wrong on these, by the way. I always hope I'm wrong. Then you get these guys. Then you get these little guys, and I'm just like, well, you know, I spent 6 months telling everybody about the setup. Nobody listened. Then everyone's just watching it like, should I buy it now? Why don't you buy it? Why don't you do a little something when it was down in the dumps and nobody cared about nuclear energy and everybody only wanted to buy NVIDIA at all-time highs? It's kind of the way this game works, man. You buy the stuff that nobody wants and you wait until everybody wants it. That's the way I play the game. Other people play the momentum game. They're just trying to see, what does everybody want? How can I buy that and then pitch it at the exact right moment when everyone stops wanting it? I don't love that game. I don't think I'm fast enough for that game. Oh my God, that's the best comment. Who said that? D-Chat? Get this stupid bubble message away from me. I can't see the chat. There we go. Yeah, it was D-Chat. That's human nature, Victor. That's why markets keep working. God, that's the truest thing you've ever said. Human nature is exactly why markets keep working. I'd argue that they're not working to the extent that they've worked in the past, though. I hope the markets are never completely run by AI. I've thought about this too, whether that's even possible. If you can neutralize information so that the only information edge anyone has is the point at which an order reaches the marketplace, I don't think there is a point where AI can quote unquote totally run the market. I don't think it's possible. I don't think it's possible, but you have to neutralize information. Otherwise, AI can become very, very powerful with asymmetries in information. It increases the edge of AI, the more asymmetry of info you have. And there are some parts of market structure that at some point in time, as AI becomes more powerful, we're going to have to deal with as an industry. I don't know if we've reached that tipping point, but we are going to have to deal with it somehow to neutralize asymmetries of information. Gold sort of staying in its consolidation range between 3,300 and 3,400. I don't think that's much of a surprise here. Silver, though, was lower at the beginning of the session by a decent amount, I think 1/3% or something like that. We had a pretty decent downside wick before recovering to 36 and change. I think my guesstimate, this is my bet, okay? My bet is we're going to stay in this new range above 35. That's my bet. That bet is going to be wrong if gold breaks to the downside. If gold does break this consolidation range, I think I'm going to be wrong about silver too, and I'm going to be wrong very fast. I think silver will move with a greater beta to the downside than gold if gold breaks the downside of 3,300. But I think for now, I've got some long deltas on in silver, much smaller position than when we got that upside breakout, but I'm going to hold it on. It does seem like a lot of this move, I thought, when silver runs, it runs crazy. We went from 30 to 38. That is a pretty decent move, all things considered. But I thought the move might be more extended. It looks like we want to consolidate here, and a lot of that momentum, that high beta momentum, may be dying out here, and it's going to die out without the exchange needing to change the margin requirement, which I thought would ultimately be the thing that would end silver's upside move here. That doesn't look like it's going to be the case. Looks like it's just normal market function at 36, 37, which means it could potentially leave stuff like this, PAAS, Pan American Silver, a little bit vulnerable. I'm long both, so I'm long silver and Pan American Silver here. Phenom says, and I hope you don't mind me reading this out loud, my wife already got laid off from being replaced by AI. If this bill passes Congress, then I'll likely lose my job too. I don't see how the economy is going to survive what's coming our way. My sister, I'm not sure if I say it, a family member, I've gone too far. A family member of mine is going through the same thing. And whether it's AI or whether it's just downshifts in expectations of growth, or whether it's sort of business climate uncertainty, I think there's been a lot of labor hoarding for the last several years. And I think it's clear to me that businesses are going through a process of shedding that excess labor. And that's brutal, man. But yeah, it's like, I'll leave you with this thought. I'm not anti-AI. Like, I don't think once you have a technology, you can put it back in the bottle. And I'm not saying that we should, regulate ourselves out of the AI competition and quote unquote allow other nation state players to take the leadership mantle. That's not what I'm saying. But what I am saying is, pretending you don't have a labor problem until the labor problem shows up and you have to deal with a crisis, that's not smart governance. But it seems like we like crisis because we use crisis to our advantage. Because in a moment of crisis, the people don't think logically. They're scared. If we were to start thinking about our problems before they turn into crisis, like for example, Social Security 100% is a crisis. It is a cliff we're going to run over. We're going to run off like Wile E. Coyote in 5 years. But instead of talking about this logically and planning for it with responsible foresight and governance, we're pretending like the problem doesn't exist. We run off the cliff. Now we have to deal with it in a moment of crisis, which inevitably means you're not going to get a good, solid plan. You're going to get stuff slipped in there for the benefit, not of the benefit of the majority, but for those that have the ability to take advantage of the crisis. So same thing with the labor market. If we were smart, right now we would be coming up with plans to upskill the labor force, to move us as a society up the value chain. And we'd start to think about what we need to do at a societal level, all the way K through 12, how we need to potentially think about reforming higher education, how we need to think about reforming sort of like job training programs and get access to people who need and want those things. We'd be thinking through those things. And we'd be delivering on plans before we run off the cliff. So that's my beef. My beef is we're pretending like we're not going to have structural or frictional unemployment. We're pretending like it's not going to happen. And that's my beef. My beef is we are trying to put in a poison pill into a bill that says you cannot regulate AI for 10 years. That's craziness. Like we're doing things that are the opposite of smart or good governance. That's my beef. And with that, it was 90 minutes of a guy just barking at the moon here. But I don't know. I hope you got something out of this. If you want to, I would love to hear more responses and make this not a one-way conversation. So there's 3 ways that you can respond. You can respond to me in public on Twitter at Victor Jones. The Owen Jones is 0 because I like to be difficult. You can respond to me in private through email or a DM on Twitter. But email is victor.jones@tastylive.com. Or the mainstream here, you cannot leave comments. I don't know why. It's just the way it works. But on Tasty Live Trending, they post this episode with the other after-hour shows. I don't know why they prefer to post 4-hour blocks of content instead of individual episodes. You got to ask somebody else. But But on those 4-hour blocks of content, you can leave comments. So if you want to start a conversation, you can do so there. With that, my friends, that is going to be our Wednesday episode. I believe Chris will be here tomorrow. He's got something. He had some personal issues going on with his home today. So I think we are swapped today for tomorrow. So we should have a good conversation with Chris tomorrow, God willing. So hit the like button on your way out the door. Subscribe to the channel. If you haven't already, follow me on Twitter. And I will see you back here. Same time, same place, same great network, only on Tasty Live. Until then, peace.